in Tower 22 when 3 American soldiers were killed, that the Iranians needed to back off, otherwise there would be very significant consequences for them. I imagine the Iranians are using that in reverse, communicating to the United States that unless Washington brings the Israelis to heel, the Iranians have the capability of raising a storm of violence in the region.
How close are the Americans to bringing the Israelis to heel, given the fact that they had this call yesterday, a strategic call, and then potentially we are going to see Israeli officials in Washington next week?
I think that the American influence on the Israelis at this point is rather limited. The Israelis frame their conflict with Hamas, and in fact, their conflict on multiple fronts, as an existential threat. Under those circumstances, although the United States is obviously an important strategic partner of the Israelis, advice given is not always advice taken. We have seen this throughout the conflict. President Biden believed that his bear hug of the Israeli government would give him the leverage with the Israelis to shape their military operations in the Gaza Strip. That has not happened. So the conversations between Washington and Jerusalem yesterday, virtually, and next week's meetings are about Israeli planned military operations in Rafah. Prime Minister Netanyahu said those plans have been approved and the IDF is ready to execute them. It's unclear whether these talks will bear fruit for the United States in shaping the way the Israelis undertake this operation.
Stephen, there are a lot of moving pieces here, and you honed in on the northern border of Israel, the border with Lebanon, the Hezbollah conflict that has been ongoing for a long time, the tit for tat, and that being the true source of an escalation that could draw in a larger swath of the region and potentially disrupt things like oil markets. I'm wondering how close you think we are to that. If you could quantify how much closer we are now after these assassinations than we were before them, it would be really important, because this is really what a lot of strategists are honing in on this morning.
Well, it's hard to put numbers on it, especially for historically minded political scientists like myself. But I would say that it is a strong likelihood that we will see a significant conflict between Israel and Hezbollah in the north. The constraints on both parties have been loosening in recent weeks and months. The strike in Damascus yesterday that killed 2 IRGC generals are something that the Iranians are going to be unable to not respond to. I think the only thing really holding the Israelis back right now is, in an odd and twisted way, is congressional dysfunction. The Israelis need that security assistance that has been locked in Congress in order to acquire the kind of precision munitions they would like to use in a conflict with Hezbollah. But I think in the next 4 or 6 months, we're likely to see a major escalation in the north.
What's to stop that from percolating out into a broader region that really does disrupt broader trade markets in a way that a lot of people have suspected was the worst case scenario?
Yeah, I think the major factor here is that the Israelis and Hezbollah get involved in a major conflict, that the Iranians and the Houthis continue to interfere with global shipping, and meaning also for the oil markets. Neither Israel nor Lebanon are major players in the energy markets, although there's a lot of gas off both their coasts. But the knock-on effects in which Iran and its axis of resistance can disrupt the global economy, as they've done or tried to do in the Red Sea, is something that I think everybody needs to be well aware of.
Stephen, appreciate your time this morning. Thanks for your insights, sir. Stephen Cook there of CFR. Need to talk about this crude market, don't we? Can we play the what if, just briefly? We've got Brent crude near to 89, WTI at 85. What if crude output in America was not 13.1 million barrels a day? Can you imagine where this crude market would be? It would
be a very different story. And that's the reason why people are looking at this and saying, especially at a time where it's not clear how much more the U.S. can ramp up production from here, how much can that serve as an offset if there is some sort of major disruption?
And could they potentially put pressure on OPEC Plus to get more involved? There is a critical meeting happening this week, and I'm not even talking about the JMMC meeting that's happening, because it's likely that they're going to continue on the supply cuts. But Jake Sullivan's going to Riyadh, along with Brett McGurk and Amos Hochstein, talking about normalization according to Axios. I don't think anyone thinks in this kind of Middle East market you could see normalization with what's going on in Gaza, but potentially they're going to talk about the oil market.
Remember how the Saudis responded going into the midterms last time around? I wonder how different it'll be this time around going into the election.
Do you think they've got a winner in mind? Is that something that they want to sway?
It was the smallest increase. It almost felt like a cut.
Yeah. Equities right now on the S&P 500 negative by 0. 0.3%. Up next on this program, the yen weakening on strong US factory data, raising the risk of intervention. That conversation up next with Mark Chandler of Bannockburn from New York City. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week,
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for bingo.
We can do that. Bingo's my cockapoo. Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
But it was present in December and we ignored it. And all of a sudden, the last month, it's all coming together and we're starting to break out.
Well, one of the big things is analysts were saying that supply actually wasn't impacted after the October 7th attack. But now when you have this escalation, which everyone is talking about, the greatest escalation since the killing of Qasem Soleimani under the Trump administration, now this means there's going to be an upside of risk premium. Then you look at the demand side, manufacturing coming out of China, and then you look at the supply side. OPEC Plus is not willing to step in right now. And what you're seeing is they're potentially going to continue ratcheting back that supply. So every dynamic is pointing to higher crude prices coming down the line.
High crude prices right now on the screen. Brent crude 88.69. Under surveillance this morning, traders pushing back bets on the timing of rate cuts following better than expected US factory data. ISM manufacturing showing expansion for the first time since 2022. The data reinforcing the Fed's patient outlook on rate cuts. More Fed speak on tap today. We'll hear from Bellman, Williams, Mester, Daly, ahead of Chairman Powell tomorrow. Bramo, we've got so much Fed speak this week. What are you looking for from all these officials through the week?
Do Raphael Bostic and Neil Kashkari
have friends?
Have lunch together? That is my one question. How much are they sitting there in the lunchroom kind of muttering, why don't other people see what we're seeing? We can cut once and then be done with it. I mean, seriously, at a certain point, how much do other people realize this isn't necessarily all that restrictive if we still see this kind of growth?
Does the message change from Chairman Powell? Heard from him a couple of times. Do you think it really changes tomorrow?
I mean, it won't change tomorrow, considering the fact that it didn't change at the end of last week. It doesn't really matter. I honestly don't know if you're looking for data, what data supports the idea of prices paid going to the highest since 2022 and higher manufacturing data than the commodity space. I keep going back to that. Isn't that sort of the gut check that this is something broader?
Well, it felt like Chairman Powell potentially moved a baby step towards Waller on Friday, and I was saying how it's so boring to hear him on Wednesday, because we already heard from him after PC, and it's going to be before jobs. But now it's a little bit more interesting, potentially hearing him after factory, after prices paid, and what we're seeing in terms of geopolitical risk. Does he have to say anything about this?
You get way more Fed officials through the week if you're staffed of Fed speakers. What did I say yesterday? I think you're not going to be on a diet this week of Fed speak, that's for sure. There is tons of Fed speak. I want to turn to this story from Tesla. Shares in the pre-market a little bit lower. So the EV maker reporting quarterly sales data later this morning. The average estimate in our survey calling for about 450,000 deliveries. That's a drop of more than 7% from the previous quarter. Falling demand, higher rates, taking a bit of a toll on orders. The stock is down by about 30% so far this year. It's the worst performer on the S&P 500. There are massive competitive issues in places like China. We've said a few times on this program this week that you'll really struggle to find many sectors in many regions that are more competitive as what is happening in the auto sector in China. And a great example of that is what happened with Tesla this week. They flagged prices were going to go up. Maybe that was a strategy to get people to order ahead of time before that price increase. What did NIO do on the same day? Provides for up to $138 million of incentives for drivers of gasoline cars to make a switch. Chery Automobile came out and said it will cover the cost of purchase taxes on selected models, plus offered better trade-in for customers' used cars as well. These stories, Lisa, that market just gets more and more competitive.
Tesla's been trying to make itself out as something more than a car company. And it's been hampered by the fact that ultimately people are looking at it increasingly as a car company. And if that's the case, its valuation doesn't make sense. I will just say, maybe this is going to be the key moment where we either say it is part of the Mag 7 or has officially been booted from that special select group.
It's taken the boot in Q1, that's for sure, in a major way. Let's turn to Japan to talk about foreign exchange. The yen weakening towards 152, making its biggest single-day move in over a week after strong US factory data boosted the dollar. Traders on high alert following comments from the Japanese finance minister that authorities are prepared to take appropriate measures against what they call excessive moves. Joining us now to discuss is Mark Chandler, Chief Market Strategist at Bannockburn. Mark, I want to talk about foreign exchange and the price action of yesterday. It was interesting just taking a snapshot of G10, WCRS on the Bloomberg terminal. I think it pictured things beautifully. Everything was weaker against the US dollar, but the relative outperformer was the Japanese yen. Just a touch of weakness. And I wonder, Mark, whether that was the first real sign that this market was taking the prospect of intervention quite seriously.
Yeah, good morning, John. Yeah, I think that you're right. I mean, but I don't think it was just yesterday that the market's been taking the Bank of Japan intervention seriously. You know, we've been knocking just slightly shy of that 152 level, and the market's been really hesitant about taking us over that level for fear of BOJ intervention, partly because the last time they intervened, October 2022, and it was around that 152 level.
What do you think intervention is actually going to look like, Mark, if they do intervene, if we do breach 152? What does it look like?
Yeah, I think that the Japanese made a mistake, a tactical error, by not intervening at the end of last week in thin markets when the U.S. and European markets were closed. What I'm looking at is, as you mentioned, I think the consensus is for a relatively robust, at least a decent U.S. jobs report on Friday and a firm CPI next week. So I think the dollar is going to move higher on the back of that. We're already getting some advance of that. And I think that the Japanese, by not intervening, they're going to be sort of forced to put the toothpaste back in the tube, so to speak, sort of reactionary, rather than first depress the dollar yen, so then it can rally on the data and not have to take out that 152 level. I think they're worried that if we go above 152, we could go to 155, 157.
Some people are betting that they're not going to put the toothpaste back in the tube, that they've got no willingness or ability to do so, including, it seems like, Mark Mobius, who was on Bloomberg Television, and he basically said there's no way that they, the Japanese authorities, are going to do anything to strengthen the yen, that there isn't the appetite, there wasn't at the end of last week, and there won't be going forward. How dangerous is it to bet that the yen will continue to weaken despite some of the verbal intervention attempts that we've heard?
Yeah, I think that the market, you know, a lot of the I think a large market segment is already shifting from sort of using the yen as a funding currency to moving to the Swiss franc as a funding currency. You can see that even today, where the Swiss franc is the weakest of the major currencies. And we also get a CPI data from the Swiss next week, tomorrow. And they already cut interest rates once, and I think the market's betting they'll cut interest rates again in June. And so I think that the market's already making this adjustment. I think it's really, I think it comes down to risk reward. Is the risk reward there to be adding on to short yen positions right now? And I think the market is rightfully being cautious about it. I do think the BOJs will intervene. Like I said, I think they made a tactical error by not intervening when they had a chance in the thin markets. But I think that's the only way to at least using these code words like watching the market urgently or with a sense of urgency or will do anything, not ruling out any options. I think these are all word cues of intervention. And if they don't make good on it, I think it sort of dilutes their street credibility.
There's a bigger point that you made within that basically this is as much a Swiss franc story as it is a Japanese yen story. And if you zoom out even further, I wonder how much a global rate cutting cycle actually helps some of the weaker currencies and hurts the likes of the Swiss franc, like the dollar, if you do get this idea that we are shifting away from what people thought were restrictive policies.
Yeah, you know, it's really remarkable. You know, I think that not only has the market moved away from a Fed cut in June. But when I just looked at the Fed funds futures, the market's not even fully pricing in the cut in July. And, yesterday we saw the Atlanta Fed GDP tracker tick up to 2.8%. And so I think you're right. I think that in a strong dollar environment, the carry trades still look attractive, and we shift to different ones for funding currencies. Mexican peso is the only major, I should say it's the only emerging market currency, the only major currency, even the G10 currencies that are higher on the year. And I think that's reflecting that carry trade.
Hey, Mark, good to touch base with you again. Let's catch up again soon. Mark Chandler there of Bannockburn on what's happening in the FX market, particularly dollar-yen. Let's do some scenario analysis. So Thanos Vambakides of Bank of America caught up with Guy and Critty in London on their show, and this is what he had to say. The yen could slide to 160 per dollar unless the Federal Reserve cuts interest rates this year. Described intervention is very likely, but it would be more likely that they would be leaning against the wind if they do intervene, and goes on to say the yen could rally to 142, but a lot of this is central bank independent. It's Federal Reserve independent. It can go to 142 if the Fed goes ahead with cuts, as expected by markets.
Which raises a question, do Japanese authorities have the ability to really intervene even if they wanted to, right? Essentially, that indicates not so much, and that's what we heard from Mark Mobius too. The fact that they didn't make a move last week tells you a lot, maybe that they're counting on the Fed to continue with what they promised.
Dollar yen, 151.65. Let's give you an update on stories elsewhere. Let's check in with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. UBS says it plans to buy back up to $2 billion of its shares, with up to $1 billion of that total expected to take place this year. The Swiss bank confirming the share repurchase plan today after having suspended its previous plan a year ago amid its takeover of former rival Credit Suisse. The bank said it expects to complete the merger by the end of the second quarter. Meanwhile, at Citi, more job cuts. A fresh round of reductions at its investment bank saw managing directors in the technology, media, and telecom division, plus equity capital market space, leave the Wall Street lender. The latest cuts coming as Citigroup says it's wrapped up the major action surrounding its reorganization plan, which aimed to streamline operations by eliminating 20,000 roles. And Disney is in the lead in its proxy battle against Nelson Peltz's Trian Partners, with more than half of all votes cast. That's according to the Wall Street Journal. The paper says BlackRock and T. Rowe Price are among the major investors backing Disney. The Journal says investors are still casting votes and can change them through the annual meeting tomorrow. Peltz is seeking a board seat for himself and former Disney CFO Jay Rasulo. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on this program, pricing in a patient Fed.
In the scenario where there are no cuts, you have to think the back end of the curve is going higher, and we could retest the 5% level at some point. There's certainly a risk that we make higher highs this cycle.
Kathy Jones of Charles Schwab, just around the corner from New York. This is Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day, you might be able to write poetry.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com webinars.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Stocks down 31% on the S&P 500. Yields higher on a 10-year new high for 2024 at 4 basis points, 435.51. Under surveillance this morning, pricing in a patient Fed.
In the scenario where there are no cuts, you have to think the back end of the curve is going higher, and we could retest the 5% level at some point, given the substantial supply that's coming on, and obviously a technical picture that's not terribly supportive. There's a reasonable probability that as the Fed first starts to cut, the back end sells off as inflation expectations get anchored higher. In the event that they don't cut at all, there's certainly a risk that we make higher highs this cycle.
Here's the latest this morning. Treasury selling off after strong US factory data pushed the odds of a June rate cut below 50%. Kathy Jones at Charles Schwab writing this. The economy is doing well, and that's the big problem for the bond market. It keeps the Fed on hold for longer, waiting for either inflation to fall decisively or the job market to slow. Neither the inflation data nor the job data appear likely to provide a breakout moment in the near term, and that's likely to mean more choppy trading. Kathy, I'm pleased to say, is with us now for more. Kathy, your asset class, together with the commodity market, are the two asset classes to watch right now. 10-year, in the last few hours this morning, new high of the year, 436.51. Kathy, what is the strongest argument to buy the long end of the curve this morning?
Well, I think the strongest argument is that inflation is still falling. And I know we've got a lot of excitement around commodity prices going on right now, but in general, what we're seeing is the trend is still lower in inflation. The core PCE is in the mid to low twos. I think core CPI will continue to ease down. We're probably going to see a somewhat slower growth rate in the job market. So we're in a soft landing, which is great. The economy is doing well, and that's all very positive. But the overall trend in inflation is still going in the right direction, and that's the strongest argument for buying, extending duration in the bond market.
Kathy, I believe last time we spoke, you talked about rate cuts might not begin until July. Is that the bias still for you, middle of the summer, or are you pushing that out just a little bit?
Well, we haven't pushed it out yet. Obviously, we want to wait and see some more data, just as the Fed is waiting to see more data on inflation and particularly in the labor market to make that call. But right now, yeah, we're still looking at a couple of rate cuts in the second half of the year, but not starting until July because obviously the Fed wants to wait and see how things are going, and actually taking no action right now is probably the best course of action for them to take. Instead of making a mistake one direction or another, they can just sit tight for a while.
Kathy, John asked me a question earlier this morning, and I really had no good answer to it, which is a more important data point for the Federal Reserve, either the jobs report that we get on Friday or CPI next week. What do you think? Because ultimately, it seems like the jobs market is almost more important to this Federal Reserve.
I would say so. With the inflation now kind of in the range where the Fed would like it to be, unless it breaks out substantially one direction or another, I think the focus can shift to the job market. If you were to start to see substantial softness in the job market, then I think the Fed would be more inclined to move more quickly because that would imply a slowdown in consumer spending down the road. Again, it remains to be seen, but I think right now jobs take on a much bigger proportion of the thinking at the Fed than the inflation numbers.
What about the other side of that? What if the jobs number is actually significantly higher than expected or comes in strong the way it has been for a number of months now, and we do see wages remaining sticky? Will you reset your view of where longer-term rates could potentially go just based on the idea that maybe these rates aren't all that restrictive?
Yeah, we'll have to adjust as the data adjusts. Right now, average hourly earnings are running about 4.1% year over year. They've been in that low 4% area for a while after having peaked at much higher levels. If it fails to come down, because I think the Fed's comfort level is probably closer to 3.5%, assuming we continue to get some decent productivity, that's not a bad story for the inflation outlook or for the bond market. But if those wages tick up or stay sticky at 4%, then we'd have to adjust our expectations for the Fed and for the bond market.
Kathy, how divided do you think this FOMC is? When you look at the dot plot relative to the last set of projections in December, it looks like things have tightened up. But when you listen to the conversations, the speeches, the rhetoric, it looks like there's some distance between the likes of President Bostic and maybe others on the committee. Just how divided, how united is this FOMC?
Well, no doubt they'll probably try to come up with a consensus opinion at the next meeting. But Bostic is an interesting person to follow because he has been a bit on the leading edge of Fed decision making. So I think that he's probably going to build a bigger faction. If the data stay relatively strong, you'll probably see more people migrate over there. But again, I also keep in mind that this is very fluid. The decision-making is very fluid. I don't think anybody is too anchored to the soft view, to the dovish view. Powell seems to be probably the most dovish, publicly speaking. But I don't know that he's 100% anchored to that. If the data change, he'll change his mind.
Kathy, his dovish stance has prompted some people to talk about maybe a lack of commitment to that 2% inflation target. And some people might draw a line between that and what's happening with gold, what's happening with treasuries this morning. Is that a step too far for you?
It is. I don't think the Fed has given any indication they've given up on the 2% target on inflation. I don't think that they will. I don't see why they would. With the economy doing as well as it is, they can stand pat and push for lower inflation. So no, what's going on in gold, what's going on in other markets, there's always a narrative around it. And my experience with gold is there's always a narrative around it. And it usually includes some sort of inflation and monetary policy story. But I don't know that any of that has changed for the U.S. We've been no indication from the Fed they're giving up on 2%.
There's also always a narrative around oil prices. And one of the questions has always been the perennial question, is it inflationary or disinflationary? When prices go up significantly because it could act as a dampening effect on growth, or it could spur prices to increase in a robust economy. This time around, which is it? How concerning is it to see oil prices really ticking up to the highs of the year?
What's interesting about the rise in oil prices to me is that it is not, there's no evidence that we're supply constrained. So this is all the expectation that demand is going to ramp up, right? And so we'll have to see if that becomes the case. We do have China maybe doing a little bit better than expected. In the U.S. manufacturing sector showed signs of life. It seems to be an anticipation of demand. It is not, super cycles in commodities usually are derived from the fact that we've underinvested for a long period of time in commodities. And that certainly isn't the case now. We're pumping record amounts of oil. So this has to be a demand story. And we'll see how far that carries if economic growth doesn't accelerate from here. But for consumers, ultimately becomes a tax on consumption. They have to shift consumption from somewhere else to pay for higher gasoline prices at the pump. So I think it has more of a negative effect on economic growth at the end of the day than positive.
Hey, Kathy, wonderful to catch up with you. Kathy Jones at Charles Schwab on Treasury yields breaking out to new highs for 2024. New highs for crude as well. Brent crude very close to 89. New note from Peter Cheer over at Academy. Israeli airstrike on Iranian consulate definitely impacting crude. And that pressure on oil translating into higher bond yields at the longer end as the inflation and potentially military spending on escalation is outweighing any flight to safety. AMH crude at 1.5%.
Yeah, and this is the risk premium we've been talking about that we haven't seen since October really start to come into the market. Given the escalation of this strike, who was the individual that was hit and what was hit? This was a government building in Damascus for the Iranians, and they've already come out and said they will have to respond. What that response looks like remains to be seen, but everyone's talking about potentially Iran likes to do this through proxies. Is it Hezbollah? Is it more Houthi attacks? Is it potentially going to maybe escalate into the Indian Ocean? We don't know yet, but there will be an escalation.
Lisa, escalation risk front and center in that commodity market.
The reason why this is nerve-wracking for the bond market, though, is what Kathy said, is that on one hand, this could be some sort of disruption to supply, but this is much more of a story that is driven by demand. And that is something that is more inflationary, at least in the short term, because it can continue, and it's not because of a supply shock. It's because of growth, and it's because of sustained resilience, and potentially even a stronger China.
Showing up in crude, showing up in gold, showing up in treasuries as well. The conversation continues. The third hour of Bloomberg Surveillance up next. David Leibovitz of JP Morgan Asset Management with us around the table, and Rita Sen of Energy Aspects as crude breaks out to new highs for 2024. Lorena Urici of T. Rowe Price and Bloomberg's Ed Ludlow on Tesla numbers coming out a little bit later this morning.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to, you can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, you know, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really is not going to be produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. You need, this is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce half a gigaton, remove half a gigaton of carbon a year. And the way to think about that number is that we have to remove, say, 100 half a gigatons, you know, a year in terms of what we have to replace.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide create index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
we're at an inflection point in the Fed's policy path and in the Fed's communications.
We're starting to see sort of a different kind of Fed narrative evolve this year. There's been some rising angst, but still I think the cuts are on the table.
There's a little bit of froth, and maybe it's deserved, as you see Powell kind of shift his narrative to things that allow him to cut.
The important thing is that the Fed and markets are in sync after being out of sync.
If you look at the market expectations of where interest rates are going to go, the Fed is actually a lot more optimistic about the scope for rate cuts over the next few years.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. Your equity market just a little bit softer. The headlines are firmly elsewhere in the commodity market, in the bond market as well. 10-year yields at new highs for 2024. And reflecting on the data of yesterday, strong upside surprises for U.S. manufacturing. Prices paid coming in a little bit firmer as well. And one question we've all got, does it derail the prospect of rate cuts anytime soon from this Federal Reserve? Citi's Andrew Holdenhorst taking the other side of this conversation today. The Fed reaction function now places a larger weight on labor market data. They see downside risk going into payrolls Friday. They look, Lisa, for 150.
Kathy Jones was agreeing that basically the labor market data really does take precedence. This is the concern, though, that some people have. What are they looking for in the labor market data? Is 150 enough to get it done, given the fact that you're still seeing inflation under the hood, you're still seeing robust data prints, including the ISM manufacturing report that highlighted how much commodity prices are feeding into higher prices for goods?
So this is what you're waking up to this morning. In the bond market, 436 on a US 10-year. Yields once again bleeding higher. In the commodity market, getting closer and closer to 90 on Brent crude, breaching 89 earlier on this morning, and backing away just a touch, 85 on WTI. This from Peter Cheer, Anne-Marie, over at Academy Securities. The Israeli airstrike on the Iranian consulate in Damascus definitely impacting oil prices, that pressure on crude, translating into higher bond yields at the longer end as the inflation and potential military spending on escalation is outweighing any flight to safety.
That strike certainly had a heightened geopolitical risk into the oil market. What everyone is describing this as in the foreign policy world across Israeli newspapers is this is the biggest risk in terms of the biggest hit to Iran since the assassination of Qasem Soleimani. Iran already says they have to respond. What is the response and how much will risk potentially there be? That's what the market's pricing in. But then you take a step back. We know that demand is potentially picking up in China, and OPEC Plus still has supply constraints. So three different movements within the oil market are all moving to say bullish on oil.
The demand piece of this, I think, is the fresher piece of this. Back in October, we had the recipe for escalation. It was the number one question we were talking about ever since the terrorist attack in Israel. Escalation risk, the prospect of a regional conflict. The demand turn that we've started to see in manufacturing, the turn in China, expansion, the official read for the first time in 5 months, the first time in 16 months, a year and a half for the United States. That's a fresh ingredient to all of this.
Which gives it more lasting power. It looks like less of a potential near-term disruption and longer-term just sort of lower for longer kind of feel in oil prices to something more sustainable. Even, Kathy pointed this out, and I thought this was really a good point. This is coming even with record production of U.S. oil. So it raises this question of, especially if China is just beginning to get back online, if you do get upside, how much that continues to fuel both the sell-off in bonds as well as inflation expectations.
Let's throw up the market board, Lisa. Look at this. Equities down yesterday by 0.2%. Given the way everything else has lined up, would you expect to see equity futures down just 0.4%, given what we're seeing elsewhere on the board?
Given the fact that we've gone up more than 10% in the first quarter and that basically every dip has been viable, even if the dip barely registers on the screen, I mean, I guess we've all sort of been benumbed to the momentum trade that seems to never give up. This is really the key question, though. At a certain point, if you get yields high enough, do you get a bigger impact on stocks beyond the Magnificent Seven that everyone's hoping can rally, even despite some of the higher yields we see?
That yield, that number on the screen right now, 436.51, that's a new high for 2024 on a US 10-year yield. Yields higher by something like 4, 5, 6 basis points throughout this morning. Coming up this hour, David Leibovitz of JP Morgan Asset Management as investors investors push back rate cut bets and redescent of energy aspects as WTI tops $85 for the first time since October. And Blarina Urici of T. Rowe Price are looking ahead to Friday's payrolls report. We begin with our top story, the odds of a June rate cut dipping below 50% on the heels of stronger than expected manufacturing data. Investors now looking to a slew of Fed speak ahead of Friday's jobs report. David Leibovitz of JP Morgan Asset Management expecting the Fed to stay the course, saying, quote, "We continue to expect progress in the cooling of U.S. inflation and for the Fed to look through any minor bumps along the way." David, I'm pleased to say, is with us for more. So, David, is this a bump in the road? The ISM yesterday, the prices paid, the rally in crude, are they just bumps in the road?
So I think that there are a couple of important things to recognize. One, to the point you were making earlier, we've been looking for manufacturing activity to pick up for a year and a half. It's finally beginning to pick up. So I'm not sure that this is necessarily new information, and I think that to an extent it aligns with what people were expecting. I think the bigger question is going to be what happens with things like crude oil, because in the short term, right, that will be inflationary. The Fed will probably look through it. But if oil prices move higher and stay higher, there's usually about a 6 to 8 quarter lag, and then that begins to show up in pricing pressure more broadly. The counterpoint to that is that higher oil prices are a tax on the consumer. And so I think what you end up with is this tug of war whereby if energy prices go up for the summer and then come back down in the fall, I think the Fed is willing to take that in stride. If energy prices move higher, stay higher, because we don't get that increase in supply from OPEC Plus, then maybe the Fed feels a little bit uncertain about the path of inflation going forward.
Bear with me here, but the data's been messy, and people dismiss it and call it bumps in the road very frequently, and it's giving me a little bit of agita, just simply because everyone's been looking to try to dismiss things as aberrations until they become a pattern. At what point can we look to oil prices and commodity prices as the best data that we have in terms of demand globally and how much and how robust the economy is?
Well, and I think that's really the key question, because to my point about manufacturing earlier, people have really been looking for a pickup in global manufacturing more so than U.S. manufacturing. And so because the U.S. has been able to keep its head above water, is this to an extent an indication of things to come? Are we going to get better numbers out of China, better numbers out of the U.S.? That helps lift Europe out of the doldrums that it's been in for the last couple of quarters. This is how you get to a scenario where you get that resiliency in growth and you don't necessarily get that rebalancing between growth and inflation, particularly in the United States, as quickly as what people were expecting. But if you're the Fed, and I want to come back to something that you guys were saying earlier, I do think that the labor market is carrying more weight. I don't think that they're exclusively focused on the labor market data, but the messaging seems to be that they're comfortable with inflation kind of moving along the path that they laid out in the summary of economic projections, which is still above 2%. And so to me, this is a Fed that cares less about getting to 2 and more about preserving and extending the expansion.
The survey that we have is a little bit north of 200,000 to be added for the payrolls on Friday. If the Fed is looking at the labor market, what do they need to see to say, okay, this is a slowdown?
So to me, the best indicator has always been jobless claims. You know, we get it every single week. It's the highest frequency. It's arguably the most contemporaneous thing you're going to get. I also think just looking at some of the survey data, I mean, there's always, over the years, we've seen these disconnects between the hard data and the soft data, and we get ourselves all wrapped around our finger. You know, just kind of look at what the balance of data is saying. And what you're clearly seeing from the surveys, which tend to be a bit more forward-looking, is that there is more resiliency in the labor market. The economy continues to power forward. Atlanta Fed GDP now is still above our estimate of trend growth. So we're kind of getting what we want, right, which is a sequential slowing in growth, and we think that over time that'll bring inflation back down to levels that are more comfortable for the Fed. It's just not happening as quickly as what everybody was looking for coming into this year.
Let's get to the stock market and talk about what everyone was looking for coming into Q2. They were looking for a big rotation. Equity futures right now, equity futures show the S&P down by 0.4%, the Russell underperforming by, let's call it 0.7% lower on the morning. Lisa asked a few times this morning whether the recipe we're seeing come together elsewhere in crude, in the commodity market, in bonds as well, is a reason to encourage that rotation that everyone is looking for, or a reason to derail it?
So I think it encourages the rotation. I mean, you've seen pretty favorable technicals up until this point with a number of stocks above their 200-day moving average, regardless of the sector that you're looking at. And, you know, a big part of our thesis coming into this year was that you were going to see that earnings story begin to broaden out. It wasn't just going to be about the magnificent 4, 5, 6, 7, whatever number of companies are in there today. You were going to see financials act better. You were going to see the commodity complex act better. And I think that this uptick in manufacturing data, higher crude prices, all of that lends itself to that broadening out and that extension right, of the rally that we've seen since October of last year. And so I actually think that while these may be challenging developments on the inflation front, they're arguably positive developments for the U.S. equity market. And I would also remind everybody that in 2022, when everyone was freaked out that higher inflation was bad for the stock market, well, it's actually good for corporate profits. And if that's what we need going forward, given that multiples have driven this rally, arguably the earnings story is looking a bit more positive.
I'm actually sitting here incredibly confused. I'm sitting here thinking, how does the Fed justify cutting rates if what we're seeing right now with respect to inflation and demand is incredibly positive for corporate profits, is an incredibly positive development for the economy? How does it lead you to cutting rates that then gives some sort of fuel to also the bond market? It's not really adding up to me.
No, and I think that that's very fair, and I'm not going to say that, you know, well, if inflation's coming down and the Fed's not doing anything, that inherently tightens policy, because Powell put that to bed a few weeks ago, but that would have been the argument at that point in time. I think that this is increasingly becoming a credibility issue. You know, the Fed started hiking too late, which undermined their credibility to an extent. They doubled down on the 3 cuts at the March Fed meeting. Do we get those 3 cuts between now and the end of the year? We think 2 to 3 is probably reasonable, but I think that the Fed has kind of locked themselves into some sort of easing this year, and it's going to get easier. And they actually did it in the forecasts that they released last month. They pushed out some of those cuts from 2025, you know, and brought down the overall number expected over the 3-year horizon. And so this is very much a time management game for the Fed more than anything else. You know, they want to give the market what it wants in the form of easier policy, but I do think they recognize that the risk is overdoing it to the downside.
If that's truly the thesis, then wouldn't you sell the long bond aggressively, get out completely, go into the front end, buy stocks, and call it a day?
That's kind of what we're doing. I mean, we're generally playing duration from the long side, because we do think over a 12 to 18 month period it can be viewed as a hedge against softer growth, but much more comfortable in the short to intermediate end of the curve, still overweight equities, and actually upgrading our views on some of the non-US markets, particularly EMX China. You know, we remain fairly glass half full from a portfolio perspective, and we continue to implement those trades.
What's that? T-bills, the S&P and chill. That's the phrase, right?
Exactly.
Or the sort of equal weight, right? Equal weight S&P.
So we'd be inclined to maybe move a little bit further out than T-bills, just to have a little bit of duration in portfolios. But I think that, you know, to your point about equal weight S&P, right, that's what's lagged. That's what everybody's looking to pick up this year. And so not just relying on the Magnificent Seven, I think, is going to be the game plan going forward.
David, love it. It's great to catch up. David Leibovitz there of JP Morgan Asset Management, getting Lisa frustrated and losing patience.
Hold on.
Hey, you're not alone.
No,
you're not alone.
It's just
I tell you.
You know, part of the problem is it's also bifurcated. Then you have the other side where suddenly you could get a total fall off in growth, and then it's the opposite. Then it's duration and get out of stock. So it's like one or the other, and this is the reason why people are kind of sitting here in a very uneasy place.
Let's get to the long end of the curve. New number for you on the screen, 450. Yields up on a session by 5 basis points on a 30-year. That is a new high for 2024. On a 10-year, just go through the bond market point by point, 2-year out to 30-year. New high of the year on a 30-year. New high of the year on a 10-year, and just a few basis points south of doing exactly the same thing at the front end of the yield curve on a 2-year yield. That's the latest in the bond market. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Heckes. Hey, Yahara.
Hi, John. Former President Donald Trump has posted a $175 million bond to put a massive civil fraud verdict on hold while he appeals it. The move preventing New York State from seizing his assets, at least for now. This also halts the collection of the more than $450 million he owes after a judge ruled he lied about his assets to get better loan terms. Trump is still on the hook for the full amount, plus millions in interest if his appeal fails. McKinsey has made a unique offer to some staff. Take 9 months of pay and go away. The management consulting firm is dangling the pay along with career coaching services to some UK staff who they would like to leave. The move is the latest personnel shakeup at the firm and comes shortly after it warned some U.S. consultants they were running out of time to get a promotion. The Iowa Hawkeyes are heading back to the Final Four after defeating reigning champions the LSU Tigers 94-87. Iowa was led by star guard Caitlin Clark with a game-high 41 points. Tigers star Angel Reese finished with 17 points and a game-high 20 rebounds. Iowa now faces UConn on Friday as it seeks its first NCAA title. That's your Bloomberg Brief. John?
It is absolutely awesome. Yahara, thank you. Up next on this program, oil hitting a 5-month high.
Crude oil last September was at $95 a barrel. We could see the crude oil market retest that. So this move in energy for us is real.
It's definitely real. That conversation up next.
On the heartbeat of the tech spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them, did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger, but drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
Story though, there's a lot of spare capacity there. I'm looking at Saudi Arabia, I'm looking at the United Arab Emirates. At what level can you see OPEC Plus, led by them, actually step in and add more supply to the market?
So I think the one thing to keep in mind is that OPEC plus, Saudi Arabia, UAE, whoever you really talked about, they are not targeting any specific price levels. For them, the key is going to be to ensure that all the inventories that have built up, let's not forget, we did have a build 2 years ago with all the US SPR that was released, but we hadn't lost Russian production. Last year, yes, the second half we drew, but on balance, the first half we built a fair bit as well, so the overall draw was small. So OPEC plus is looking to draw down the excess inventory to make sure that the market is in balance, and only then will they gradually bring back production. And again, gradually is the key word. You're not going to see them come back with all their voluntary cuts back. It will be a very slow process.
If you say this is a supply issue, which is interesting because a lot of other people have come on the show and said it's very much a demand issue. If it is a supply issue, how much can U.S. production increase from here to continue to offset any demand or any supply that gets taken off elsewhere?
So the U.S. production, we actually don't think goes back to 13.3 million barrels per day until July of this year. So it's going to go back up there, but it's going to be a gradual process. Last year, the surge we saw was also driven by a lot of M&A activity. Companies were getting bought, and just before they got bought, they were surging production to increase their valuation. That's kind of coming to a halt. Companies are actually needing to build quite a bit of inventory, like well inventory, so that's what they're doing right now. So production growth is going to be slowing down this year. And then against that, demand is good. It's about 1.4, 1.5 million barrels per day of growth. And that's why I think the fact that you've seen supplies not grow as much as what we've seen last year has caused these imbalances in the market.
And Rita, these oil prices spell higher gasoline prices in the United States. Do you think the U.S. will draw on the SPR, and how much do you think they will draw on the SPR?
I absolutely do think the U.S. SPR release is on the cards this summer. Let's not forget that it's an election year. The U.S. has been refilling at about 3 million barrels per month. That has been continuing, but now with WTI prices where they are and Mars prices above $79, I think that's going to stop. The refilling is going to stop. But I do think about, say, 30 million barrels, which tends to be the volume that gets announced for emergency releases, can absolutely be used in the summer should oil prices go up. Now, oil prices are not the same as gasoline prices, and releasing crude oil inventories will do very little to alleviate $4 gasoline prices, but this is politics.
And Rita, you used a couple of words. Politics is one, another one is emergency. Can you talk to me about how we define emergency? What the purpose of the SPR was and is, and when it became a political tool going into elections?
So I think historically, the SPR was very much designed for and used only for pure supply disruptions. 2011 Libya. And then subsequently, like whenever you've actually had a supply outage. Russia, there was an expectation that we were going to lose Russian supplies, but the sanctions in reality were never really designed to make Russian oil off or take it off the market. So that's why it was a bit of an incongruity when you saw SPR being released, but the sanctions were actually not designed to take the Russian oil off. But that's when it started to turn, and we actually do sense, and I was in DC just a couple of weeks ago, the sense I absolutely have from them is that now the SPR more widely is used as an energy policy tool. It's no longer just for supply management or supply loss management.
Interesting. Amrita, thank you for weighing in, and Rita Sen there of Energy Aspects. Now, do they have space for this? Arguably, looking at the supply dynamics in America right now, at 13 million barrels a day, record production not just in America, but worldwide. You can make the argument they have space for this, but ultimately, this is a shift, Bramo. It's a big shift from what this tool used to be and what it's used for now.
And how long it can continue if they don't replenish it, right? I mean, that's been one of the issues. How much firepower do they have? My question really goes down to, let's say Saudi Arabia doesn't bring more of their barrels back online heading into the election. What this leaves this administration with in terms of tools to offset that? I mean, does it become basically a policy war between the different kind of oil centers warring up against each other for political aim? Is that what we're looking at?
Well, Amos Hochstein, Jake Sullivan are going to be sitting down with Mohammed bin Salman on Thursday, and I think what they can put to him is, we can tap the SPR again, which we know the Saudis didn't really like, or you could potentially start to use some of your spare capacity. They're putting out, what, just a little bit under 9 million barrels a day? They can go to 12. They have that spare capacity. They could cushion the market. Do they want to? WTI, 84.95, Brent crude, just in and around 89, 88, 61. Coming up next on this program, Lorena Urici of T. Rowe Price on a busy week of Fed speak and US payrolls data due on Friday. That conversation is just around the corner. Crude breaking out in the last 24 hours. Bond yields breaking out as well. A 10-year yield of 4.37, a 30-year through 4.50. From New York, this is Bloomberg.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was
The way I think about culture is they call organizations superorganisms. It's a collection of people, but the collection is greater than the individuals combined. So 1 + 1 is not 2, ideally it's 3 and greater. So if you were to look at a single person, a person has a set of core values, they may have dreams and aspirations. If you kind of map that to an organization, you can also think of the culture as your core values, personal core values turn into corporate core values, your organization's strengths and weaknesses. All those things collectively combined is something that we kind of put a label on it called the culture. A culture is like a muscle memory. It's very hard to change a habit. It's very hard to just say, hey, today we're going to define our culture as XYZ. We're just going to change this way. Like, it doesn't work like that. It's a collection of people's habits That's like, again, like a superorganism. So you have to like really nudge and create an iterative feedback loop. It's a slowly evolving thing. So that's why it's so critical. Like your day-to-day decision-making, day-to-day operation, everyday execution is really dictated by the culture of your organization, not by a couple of like checklists. It's not what you write on the wall. It's what you do and live and breathe every day. And that is the culture.
Sort of small caps down 0.7. If you want to know what's happening, it's happening elsewhere. It's happening in the bond market. It's pretty impressive how well so far, and I stress so far because I can't predict the future, but how well so far this equity market has stood up to developments in the bond market. A double-digit move yesterday, yields up. A move this morning, mid-single digits, 6 basis points, yields up. 437, new high for the year on a 10-year, on a 30-year. 451, Lisa, new high for the year on a 30-year.
Well, and it's the why, and that's what everyone said when they come on the show. Well, you know, yeah, higher bond yields aren't great, but they're higher for the right reasons, basically because demand is more robust and growth is strong, and that should be good for stocks. This is the sort of rub. People say that there should be a broadening out in the market, and that's what we had been seeing. Today we see the opposite. Equal weighted is underperforming. We see Russell 2000 underperforming. So how consistent can you see the story of a broadening out and some of the smaller companies truly rallying on the heels of higher bond yields?
The one broadening out that might continue based on what we're seeing in the next board, and you can go to commodities, energy equities in March up by something like 10%, encouraged by this move in crude again, 89 on Brent, 85 on WTI, and plenty of reasons, I think, for a lot of people, Lisa, to be bullish crude at the moment.
From the demand side, because people say that, you know, potentially even China could be coming back online. And then also, as we were hearing from Marita earlier, from a supply side, this idea of potentially curtailed supply, whether it's Mexico or whether it's in the Middle East. And this is really kind of going to the heart of, is this going to be disinflationary or inflationary at a time where demand is still strong?
The geopolitics in the mix as well. Under surveillance this morning, top story for you. Iran is blaming Israel for a deadly airstrike on its embassy in Syria. The strike in Damascus late Monday, killing at least 7 Iranian personnel, including senior military commanders. Israel has yet to confirm the attack. Meanwhile, US and Israeli officials agreeing to continue talks ahead of an expected Israeli operation into the Gaza city of Rafah. Anne-Marie, that event yesterday, really, really important for what's developing in commodities.
Absolutely. Heightened tension in the Middle East. And this is truly heightened tension given the fact that this airstrike is the biggest in terms of assassination of this Iranian Revolutionary Guard leader since Qasem Soleimani. And now everyone looks to, then what's next? We know Iran will have to respond. How do they respond? They usually go through proxies. Does this mean Lebanese Hezbollah to the north, more Houthi attacks, potentially moving into the Indian Ocean? We don't know yet, but we do know that they said revenge is coming.
The risk going back to October, at least at a prospect of a regional conflict.
And it's honestly simmering, and we've heard that earlier from some of our guests. Basically, it's going to escalate on some level. The question is when markets kind of are percolating, waking up to it, is that kind of what we're seeing right now? This is really hard to get your hands around. The more interesting question right now to me is, has the U.S. kind of lost its clutch over Israel, and Israel kind of going it alone? And is that really the main risk? Not Iran, but Israel going after Hezbollah in the north.
We heard that, I think, from Stephen Cook of the Council of Foreign Relations, and he certainly alluded to that, but maybe we overestimate the influence the United States has on Israel and the leader Netanyahu. That was kind of what he was alluding to.
He also spoke about how Iran doesn't want a disruption to its main source of income. It doesn't want a disruption to the oil market. Israel has a goal. It is to root out Hamas and to root out some of the Iranian proxies that have made it unlivable in certain areas of the country. So that has become really the dueling goals that are not really working together too well.
Clear and obvious escalation in the Middle East. These aren't major moves in the commodity market, but you're just starting to see that breakout continue. Brent crude, 88.59, 84.95 on WTI. Our next story, President Biden will visit Baltimore on Friday to survey the collapsed Francis Scott Key Bridge. Currently only a small shipping channel is open since the disaster at the port of Baltimore last week. The Washington Post reporting the companies which own and operate the container ship Dali have asked a federal judge to excuse them from any liability or cap damages at $43 million. AMH, big question last week. Where's the liability? Where's the liability and who's responsible? Where does the money come from?
We heard from the Treasury Secretary, we heard from President Biden that there is going to obviously be some liability when it comes to the company and their insurance providers, but the president said he wants to get federal funding there as soon as possible. So some federal money did go there immediately, but we heard from Karine Jean-Pierre yesterday, and she pretty much insinuated there is going to be a bit of a fight when it comes to this in Congress. Is Congress, which you have many on the right saying they need more fiscal discipline, going to want to spend billions of dollars to a blue state of Maryland? And she said yesterday, it's a complicated scenario. We're going to have those conversations.
Money and time. Money, lots of it. Time, who knows? Weeks, months, years? It's certainly not going to be weeks to sort this mess out, is it?
This is my shocked face for the fact that things aren't going to move quickly in Washington, D.C. I mean, essentially. But at a certain point, you have to wonder, okay, well, then what gets clogged up in the meantime for the region?
Let's look ahead. Hotter than expected factory data weighing on markets, pushing back rate cut bets. The ISM manufacturing gauge showing expansion for the first time in 16 months. Investors looking ahead to a slew of employment data this week, including JOLTS, ADP, jobless claims, and U.S. payrolls on Friday. Blarina Urici of T. Rowe Price saying this: the payroll data this week are likely to show the economy continued to add jobs at a healthy pace, but that the January strength was likely distorted. We will need to watch the JOLTS report closely once again for all its flaws. Blarina joins us now for more. Now, Blarina, can we talk about the D word that you used for January? Likely distorted. What did you mean by that?
Well, when you look at the inflation data and the labor market data, there was a pop in January that was not corroborated with what we've seen in February and what we've seen with the trend in the economy more broadly. Perhaps that weakness in inflation we saw in the second half of last year was exaggerated also, and it was more pronounced than the underlying strength of the economy probably allows. But also, I would say that January looked too strong, and the economy, both on the labor market side and inflation, is going to moderate in the coming months. Now, the big question is how much and how much space is that going to allow the Fed to cut interest rates this year?
You said to look ahead to the data and the JOLTS report, and I think you referred to the JOLTS report as flawed. Can we talk about the flaws in the JOLTS report? It's interesting because I know you're not alone. A lot of people would agree with you. There are flaws to the JOLTS report, the reporting, the way they gather the information. But Chairman Powell himself looked to JOLTS, job openings, quits, as evidence that maybe their policy stance was having an effect on the labor market. Is that why it's important to you later this morning?
Well, we are all paying attention to it because it was an early indicator of the extent of the tightness of the labor market. That spike in the vacancy rate, the increase in quits, they all told us that the balance between supply and demand in the labor market was really off. But we know the issues, that some of them which you mentioned: response rates, sample size, some job posting being online but not really being serious job postings. So we have to look at a range of data, but there are some aspects of the JOLTS report, such as the quits rate, which I think are very timely, and they've been correlating very well with wage inflation lately. So I would look at this, and there is a bigger question here that we're discussing since the CBO report in February, which alluded to about a 3 million positive labor supply shock to the economy in 2023. And that question is, what is the run rate or the break-even rate of payroll growth for the U.S. economy this year? Should it be around 100K, as we had been expected before? And that 100K employment growth means that the unemployment rate can stay more or less flat, or is it higher? So in that case, if it is higher, strong employment growth does not necessarily need to be inflationary, and the unemployment rate will not decline further. So for this, that's what I alluded to in that note. For this, we need to look at what happens with vacancy rates in the coming months and what happens to the quits rates. Because if those increase again, then this report is telling us a different story. It's telling us that the labor market is becoming unbalanced again.
Blarina, how concerned are you that people are too quick to dismiss good data as an aberration?
Well, it's a fair question. We have tended over the last 2 years to be a little bit too optimistic about the U.S. economy not taking into account just how strong the U.S. consumer was and how that was going to pull the economy forward. We got some fiscal tailwinds as well. Now, the question about January is not so much about dismissing good data, but taking it with a pinch of salt and saying the economy is in a solid footing, but is it overheating right now when interest rates are as high as about 5% or not?
Well, Blarina, this is the reason why I find oil prices so interesting today. And it's not just oil, but it's commodities more generally. If we are looking at messy data when it comes to some of the incoming economic figures, can't we just look at the commodity space and say that this is evidence of just how much demand there is out there at a time where you're seeing growth come back, not only in the U.S., but also in places like China?
So that's a fair question. And the thing with commodities is that there are so many factors that drive it. It can be geopolitics, it can be shocks to supply, and it can be demand. So basically, putting the relevant weight on those factors matters a lot when you're going to use commodity prices as a signal for what is happening with a broader economy. But another thing we know about this business cycle is that the U.S. economy has really overperformed, rather, the rest of the world and emerging markets. So this pickup in commodity prices could well be signaling that those economies that had been underperforming the U.S. are coming back online. But I don't think it's telling us something new about the U.S. economy.
Before you go, can you help us translate the Fed speak ahead of time? Can I just go through the calendar? Bauman, Williams, Mester, Daly, Bauman, Goolsbee, Powell, Barr, Kugler, Harker, Barkin, Goolsbee, Mester. I mean, Blarina, how is any of that helpful? I don't know, but that's the schedule. Can you tell me what you're looking for this week?
How much time do we have? It's a really, really packed calendar this week, both with data and with Fed speak. I would say I'm looking for how is the committee consensus evolving. We know that they want to signal they have a cutting bias. The data is getting in the way of the Fed cutting, perhaps by as much as they want. They've signaled in March 3 cuts for this year, and it feels like that's basically the ceiling for the market. And any positive surprises to the data run the risk of, first of all, pushing the first cut to July and also pushing that number from 3 cuts to 2. So how is the consensus evolving? How are the hawks dealing with this? I'm interested to know who those 2 daughters are. And also, if I'm not mistaken, we have Powell this week. And so I would say he was fairly dovish during the press conference, slightly less dovish in this interview on Friday. And so I want to hear from him today what is his personal view. He's going to speak specifically to the economic outlook and what are the milestones in the data, because he'll say they are data dependent. They will stick to the strategy, but what data are we looking at and what are the ranges that will guide them towards a cut? Because they've also said we're not too sensitive to good news on the labor market and growth so long as inflation continues to slow. So is he going to stick to that?
It's a good point. Blarina, we've got to leave it there. Blarina Urici there of T. Rowe Price. As I was reading all those Fed speakers, I scrolled down, there was another 7.
Well,
going into Friday.
I have a lot of questions.
Another 7 scheduled speeches.
I actually am looking forward to it. These are the questions that I would like answered.
Please, go ahead.
Directly.
You made a list?
People, yeah. Who eats lunch together? How happy they are with Powell? Whether they get together frequently? What they're looking to communicate? What data they're looking for? And then, most importantly, what they think of, bonds.
Is this Fed speak or Mean Girls? It's like high school or the FOMC. What is this?
No, I want to understand.
Who has lunch? What they think of the headmaster?
Yeah.
You can't sit with us. That's the vibes you're giving off today, Lisa.
Look, they're all going to say, look, we all get along, et cetera. But there have to be camps that are starting to get formed.
Sure.
There's a consensus that's kind of fraying around the edges, and we saw that in the dots. And I'm curious about that.
Within that is a serious question. I know that. I just want to pick up on what's happening in the equity market. That slide's picking up. We talked about it being contained in yesterday's session, maybe being contained just a little bit this morning as well. We're down about 0.6% on the S&P, starting to sort of catch up with what's happening happening in bonds, Lisa, and what's happening in commodities this morning?
It challenges the valuation proposition at a time where some people are getting a little queasy about the idea that this sort of incredible rally, the biggest two-quarter rally that we've seen going back more than a decade, how much it can really kind of keep surviving on momentum alone, John.
I liked what Blarina said, though, about what's more important with Chairman Powell, reflecting the consensus of the committee in the news conference of the Federal Reserve and maybe just getting a little bit more of his own opinion across in the next couple of days. It's worth looking for.
Yeah, how much of the dovish tilt is him versus trying to reflect the committee?
Precisely. Put it better than I did. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Boeing's bumpy year is being felt by pilots at United Airlines. The carrier has asked pilots to take unpaid time off next month as it grapples with delayed deliveries of new Boeing planes. With fewer planes, that's reduced the number of flying hours United had planned for its pilots this year. And the additional time off could reduce excess staffing. The move could extend into the summer and potentially the fall. UBS says it plans to buy back up to $2 billion of its shares, with up to $1 billion of that total expected to take place this year. The Swiss bank confirming the share repurchase plan today after having suspended its previous plan a year ago amid its takeover of former rival Credit Suisse. The bank said it expects to complete that merger by the end of the second quarter. Rubrik, a cloud and data security startup backed by Microsoft, has filed for an IPO. This adding to the roster of companies planning to go public after successful trading debuts by Reddit and Astera Labs. The size and price of Rubrik's planned share will be disclosed in a later filing. That's your Bloomberg Brief. John?
Yahara, thank you. Just an update on what's happening with Rivian. They just came out with first quarter vehicles. The numbers, they delivered 13,588 against an estimate of 11,893. So that's an upside surprise. The stock is firmer in the pre-market. Still waiting for numbers from the big one from Tesla. Up next on the program, lowering expectations for Tesla.
All EV makers have had to lower their prices a lot in order to maintain demand. We've seen a game of market share moving back and forth between BYD and Tesla. I think Tesla is more or less finding a floor in China.
We'll catch up with Bloomberg's Ed Ludlow up next on the program, live from New York City this morning. Good morning.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The Deal?
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
This is Bloomberg.
"42 minutes away from the opening bell in New York City, day 2 of Q2. and it's shaping up as follows. This equity market starting to wake up to what's developing elsewhere. The S&P 500 down by 0.6, the Nasdaq down by 0.8. We're down 1 full percentage point now on the Russell. The small caps lower. Here's the elsewhere. Switch up the board and get to the bond market. The 2-year yield very, very close to the highs of the year. The highs of the year, 474.89. Right now, 472.84. On a 10-year, double-digit move yesterday, up another 9 basis points now this morning. There's your new high for the year, very close to 440, and Lisa, a clean break of 450 on a US 30-year.
It's the why that I find interesting. Yesterday we got the ISM manufacturing data and the prices paid that came in higher than expected. Today, is it oil? Is it just this idea that maybe people are not as sanguine with this idea that the Fed can kind of truly cut rates in a significant way? The why might be more important right now.
It might be on the next board. Let's talk about the why. Brent crude, very close to 89, breaching that level early this morning, 88.45, up by a little more than 1%. WTI up by about 1.3% to 84.80. At least the tension in the Middle East, a big part of that story too.
So this is really the interesting part of the people who we've talked to this morning. There were people saying it's a supply story, including Amrita Sen, and then there are plenty of people saying this is a demand story, including Kathy Jones, saying it is because this economy is so robust. It matters because it sort of depends on how persistent it will be and whether it could be potentially more inflationary or less.
Put it all together, add it all up, that's the recipe for stocks moving south. We're down by 0.6% on the S&P 500. Under surveillance this morning, lowering expectations for Tesla.
All EV makers have had to lower their prices a lot in order to maintain demand. We've seen a game of market share moving back and forth between BYD and Tesla. I think Tesla is more or less finding a floor in China and in a place where they can maintain the kind of volumes they've been selling in the country in recent months.
Here's the latest this morning. Analysts cutting estimates for Tesla vehicle sales as the EV maker faces slowing demand and higher rate pressures. A Bloomberg survey saying analysts expect first quarter deliveries of about 449,000 vehicles. That would be down 7% from a record fourth quarter. Bloomberg's Ed Ludlow joins us around the table for more. Ed, this number could drop in the next 60 minutes or so.
Right.
Are we going to see a Tesla problem or an EV problem?
Both. You know, Tesla has a clear strategy, right, which was heavy discounts towards the end of the quarter in all markets, and they telegraphed it. They said, come April 1st, we are going to raise prices, which is interesting in the context of China because everyone else in China did the opposite, continued to cut deeper with more incentives, and Tesla stuck to their guns. I mean, Pierre talked about finding a floor based on the actions they took this week. They found it, you know, and particularly in the kind of $40,000 US range. That's the problem, you know, with the market. It's pricing, the sensitivity is well discussed. The Tesla problem is they only make 4 cars. And what we learned in the quarter gone, particularly in North America with combustion engine cars, is consumers love choice. They love a really cheap sedan. They love the sort of cheap SUV that has a gas engine right now. And the Model 3, Model Y in particular, which is 90% of Tesla's sales, it's not really resonating anymore.
Is anyone actually buying Teslas outright, or is everybody leasing and sort of are they depending completely on financing from someone else?
Fantastic question. The impact of rates is there to see. Elon Musk has even talked about the impact of rates. You know, it's one of the bingo card items in earnings calls, whether he'll talk about the Fed and rates. In this country, it's particularly important on financing. At the end of last quarter, in fact, last week, I leased a Model Y because the leasing cost was so low, $300 a month. But if I were to have financed that vehicle from a sheer cash flow perspective, you're talking $600 to $700 a month because of the high impact of rate penalties.
What would the argument, though, have been for you to buy it outright? What would the advantage have been? I'm serious. I'm asking because
for my personal economics, it wasn't an option. But I think the answer is 3 years from now, or you think that Tesla's strategy to keep the Model Y relevant is software updates. My kind of thinking was, well, it'll probably be obsolete in 3 years' time, so what's the point? You might want to change your EV with a greater range or more complex software, whatever it might be.
Ed, I want to ask you about China, because last year, when you see the uptick of Chinese individuals going out buying cars,
yes,
a quarter of those cars were all going to EVs, not hybrids, EVs. If Tesla's not competitive in China, can they be a global EV leader?
Well, Tesla's going through in China what kind of Mercedes went through. It has a brand identity. It is a Western automaker where there is a status implication of buying a Tesla. The difference in that market, as you point out, is it's much more mature. There's higher penetration of EV sales. but there are many more domestic players offering a wider range of price points. Xiaomi is the story of this week, right, where they're coming out with a $30,000 EV. Whether it materializes or not, we'll see. And at the other end, you do have the luxury players, Mercedes, with their battery electric equivalents. The problem Tesla's having is finding where it sits there. You know, Pierre Ferragut was talking about the floor on pricing, but there's also the design and spec of a Model Y or a Model 3. Where does it sit within the landscape? And right now, it's kind of that mid-nothingness of the market, where it's not a luxury car, nor is it a budget option either.
They almost look like each other. Would you say that the Xiaomi is almost a Tesla Model 3?
Oh, let me get into Ed Ludlow, the car critic, but the curvature, the design. I mean, the criticism that people have with Model Y is it's just a chubby Model 3. It's not actually an SUV. And that, in the North American market, is absolutely key. It's why Rivian at first had a lot of success, because 75% of American purchases in the last decade have been light truck category, big, bulky SUVs. Since moving to America, you see it on the streets, right? That's what I've lived. The Model Y is not that. And again, it goes back to what we discussed a moment ago. Where did the existing lineup for Tesla sit in all of these different markets? They're very similar to everything else that's out there right now.
I have one question, and it's sort of dominated, for me, I think, this industry for the last couple of years. I've been pretty consistent on this. If demand is so great, if these vehicles are so good, why is there a price war?
Well, that's the thing, is that I don't know that demand is so great. You know, it's important to state the basics. We still have growth in EV sales.
I'm talking specifically to China.
Yeah.
Is there a price war in a market that everyone heralds as the market for EVs? It's great, everyone wants them. Why is there a price war there?
Policy. Because the Chinese government were much quicker than the US to put policy support in place in the first place, but then take it away. You forget that actually there hasn't been government-led incentives in China for about a couple of years, which means it comes out the pocket of the automakers themselves. You have to get the balance right. You unlock addressable market by cutting prices, you lose on the bottom line, and then that market runs out. You know, there are only so many people buying at 40 grand, even in China.
Yep, this is precisely, Lisa, what we're trying to get at. There isn't a viable market without the policy support anywhere. There isn't one in China, there's not one in Europe, there's not one in the United States either. You need the policy support for this to grow.
And the reason for the policy support is different depending on the region. In China, it might be to be more independent from some of the fossil fuels that they import. For the US, it might be for green ambitions, but it's different, and there are different price kind of underpinnings as well for both regions.
Ed, this was great, just fantastic. Looking forward to Bloomberg Technology a little bit later on today with Ed Ludlow and Caroline Hyde. Looking forward to tomorrow because we're going to have a lot to talk about. Mark Capital of Allspring, Gilles Moek of AXA, Michael Collins of PGIM, and former House Majority Leader Eric Cantor as well. Your equity market's breaking down just a touch. The S&P session lows, negative 0.7%. In the bond market, yields very close to session highs and new highs for 2024. Your cash open 34 minutes away. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
A cruise ship is much more than a flotilla of financials and numbers. Naftali Holt showed me around the Celebrity Beyond, Royal Caribbean's newest ship, rolling out not the red carpet, instead the magic carpet, an example of investment that's yielding returns in several different ways.
Originally, actually, we designed it because we wanted to have a really nice platform for tendering, because sometimes we can't home port
So
destinations.
functional.
Exactly, value functional. And then we looked at it and said, why don't we just make it a really cool feature spot where people can enjoy it beyond the functional space? And we created this bar. It went up and down.
Now, what does it take to
How
do?
about the Instagram? Can you speak about that?
I can imagine.
Instagram moment with the sunset, having a drink with your friends or family. I mean, that's amazing.
So what does it take to do something like this? And I'm thinking cost, engineering, time.
Yeah, a lot of effort from a lot of people. So it starts from just the design and the conceptual aspect of it. Then we need to figure out a lot of technical factors, the weight, the wind, and so lots and lots of hours of really hard work. And every time we up the game, we see that customer willing to spend more.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
From New York City for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Farrow. So bonds and equities are spooked. 10-year yields hit the highs of 2024. Are the vigilantes being woken from their slumber? Stocks are lower. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
The markets are on edge. Traders turn more hawkish than the Fed. Treasury yields hit a 4-month high ahead of Powell and payrolls. And crude tops $85 a barrel. OPEC cuts and geopolitical risks intensify. We begin with the big issue. It is all about the data.
In the coming months, inflation should, along with the labor market, weaken. Where we are more worried is that the market seems to have, and I say the market, the equity market and also bond pricing, seems to have this implicit faith that the kind of growth we have seen in Q3, Q4, and some of the early numbers in Q1 have also been quite strong. They're extrapolating that. We are looking for weaker growth. So for me, the left tail risk is much more on growth, where we are really different from consensus, where the market is, again, looking for about 3 cuts in 2025. We're looking for 5 cuts in 2025.
A contrarian view. Let's bring in Mike McKee with me to set the table. Mike, good day to you. Bano Baveja out there on a limb, 5 cuts for 2025. Not what we're seeing in the markets this morning, and Fed speak coming along.
Definitely not what we're seeing in the markets this morning. You know, a couple of months ago, you and I were talking about when is the market going to get on the same page as the Fed? Now it's a question of when does the Fed get on the same page as the markets? Take a look at what we've got this morning. Markets have now priced out the idea of 3 rate cuts. There's still a 66% chance, basically, of 3 rate cuts this year, but it's below certainty. So the markets are now thinking the data is telling them that we are not going to be able to see the kind of rate cuts that they were expecting just a couple of months ago. Today, more data to deal with. The JOLTS numbers come out at 10 o'clock this morning, job openings and labor turnover, the quit rate. That's going to be very important. This has been part of the Fed's narrative. The labor market is strong because there's still a lot of job openings, and there are still a lot of job openings. Factory orders, not such a big deal. We got most of that from durable goods orders. And then we have Fed speak. Now, we're going to have to start parsing these because there's a lot of Fed speakers over the next 2 weeks, and not all of them are going to be talking about things the market necessarily cares about. Bowman and Williams today, Bowman's talking about banking, and Williams is just being a moderator on a panel. But Mester and Daly are making monetary policy comments, including Mester's economic outlook. So something to watch. We'll see if she says anything about 2 versus 3. And of course, tomorrow, we got to pay attention tomorrow because we get ISM Services, ADP, and Jay Powell back again, and he certainly made some news last Friday. Speaking of JOLTS, let's take a look at what we've got here. What you're looking at is almost 9 million job openings, and the average is the white dotted line below. Pre-pandemic, it was running about 5.5 million. So at this point, we are way above that. The quits rate is still above the pre-pandemic quits average for the 10 years before the pandemic. So we still have a strong labor market. We'll see what we get at 10 o'clock this morning.
Okay, all eyes down for that first piece of data. Mike, thank you very much. I want to show you what a bond market when it's erked looks like. 2 days and less than the second day's session in. We're 18 basis points higher in yield. Jolted by the ISM data and the prices paid. Let's bring in my guests to the conversation. We have Invesco's Christina Hooper, PIMCO's Aaron Brown. Aaron, let's start with you. Bond house. It's a bond day. It's a bond 2 days. Do you think we've just had a sort of a reawakening of enduring higher inflation? And now the market is ahead of the Fed at less than 3 cuts.
So firstly, I think this is the first time, certainly year to date, but even going back into late 2023, that the bond market is now probably fairly priced relative to its expectations for future rate cuts. And so we've been in an environment where I think the market's been overly optimistic about the pace of cuts that we'd see, certainly in 2024. And I think now we're getting back into really the sweet spot of what I think is realistic in terms of market expectations. With respect to the data, yesterday's ISM certainly was a bit of an awakening, but it wasn't the first print that we've seen year to date that's been better than expected. In fact, I think it continues along a line of both a cyclical upturn, not just in the US, but really on a global basis, where we're starting to see even recession risk priced out of Europe and other economies in the developed market. And we're starting to now see a more robust outlook into the second quarter and the second half of the year. In addition to that, we're also seeing very sticky inflation, and we continue to believe that this last mile of inflation normalizing is going to be the most challenging, and is also going to be the most volatile with speed bumps along the way. So we're really now in what I think is going to be a more challenging, less directional macro environment going forward, which I think is why we're seeing more volatility, and you know, certainly in the bond market, but in markets more broadly as well.
Aaron, hold those thoughts. Christina, I will come to you in just a moment. We have got the news flow that we've been waiting for all morning, which is the Tesla deliveries for the quarter. Abigail is with me here. This is a pretty brutal reading, Abigail, way under the estimate at 386,810.
Absolutely. That's 14% below what the street had been expecting. They had been expecting closer to 450,000 vehicles, more precisely 449,000. To your point, what you just mentioned, the actual number closer to 387,000. So again, a large miss there, double-digit miss in terms of the vehicles produced. Now, this isn't surprising. Wall Street analysts have been bringing down their estimates into this, but this is a bigger mess than folks likely expected, given the fact that the stock right now is at pre-market session lows, down 6.5%, and the breakdowns are negative too in terms of the 3Y production missed, the first quarter production overall of 433,000, a little bit more, missed the estimate of 452. So there's not a lot of good news here for the Tesla first quarter delivery and production numbers, and the stock is really showing it in a big way, down 6.4%.
Yeah, it is. This is going to be the first year-to-year drop that we've seen since the pandemic, and it is a brutal below estimate read there. Let's return to my guests. I mean, there's volatility in the EV sector, but Christina, good morning to you. There's volatility in this bond market, and in terms of perhaps complacency, one could say, in the bond market, we're breaking higher by 18 basis points. This is a real reawakening for the bond market, isn't it?
Well, it is, but I do believe that there's something of an overreaction going on here. Let's face it, the Fed is not going to be making any critical decision until June. And I still think June is very much in play. I do anticipate the Fed will cut rates in June. There's going to be a lot of data between now and then. And while, yes, this one particular print yesterday did jar markets, I do believe we're going to see more in the way of data that suggests we are still very much on the disinflationary train. What we've heard from the Fed is that conditions as they are today, given the progress in disinflation, monetary policy is very restrictive. And there doesn't need to be any kind of significant weakening in the labor market or therefore the economy for the Fed to act. So My opinion is this is an overreaction driven by confusion because we have admittedly gotten a lot of hawkish Fed speak as of late. But I am still very optimistic we will see a rate cut before the end of the second quarter.
Christina, if we just take that for a moment and pause for thought, the PCE on a 3-month and on a 6-month basis is closer to 3 than it is closer to the target. Do you think that they could and should cut rates so far away from the objective target? Waller, of course, was saying that he wanted a sustainable trajectory towards 2%. Briefly, before I go back to Aaron, do you really think that far away from the milestone they should be cutting?
Absolutely, Manos, because there are long variable lags between when monetary policy is implemented and when it shows up in the data. So we haven't seen all the impact of the rate hikes that have been enacted thus far.
And Aaron, if I take it back to you, you talk about the final mile, and I get this, the final mile on inflation, but that core of 2.5% to 3% on core inflation is the underlying trend, and the question becomes, is the Fed okay with that? And the same to you. Powell did use the word restrictive, and I think this is a much overlooked issue from later last week. He used the word restrictive, and so therefore, do you see comfort at the Fed cutting in the band with 2.5% to 3% on core PCE, even on a 3- and 6-month basis?
So I think restrictive really is the key word. And where we stand today, rates are north of 250 basis points, if not more, in excess of what they would see as the long-term neutral rate. So even cutting into a still elevated inflation level is going to bring rates still staying within the restrictive territory, but just a little bit lower. And so they still think that given that we're cutting into what will still be a restrictive environment, it still is going to put a dampener on growth and certainly on inflation, and eventually, normalize inflation back down to a level that they think is reasonable. So I do agree that they'll likely start to cut rates at the middle point of this year, concurrent with the summary of economic projections, which is in September. But I think that the pace is going to be much more moderated than what you would expect during a traditional, more normal rate cutting cycle.
So, and I appreciate both of you perhaps taking some of the excitement of me of 18 basis points in 2 days out of the market. But here's the thing to both of you then. Should I be gorging on duration when I see little bumps like this, little bumps in the road, 20 basis points, pick them up, add incrementally? Christina?
Yes, I do believe so. And there are also opportunities to enter equities if markets get too negative on what they anticipate the Fed is going to do.
And Aaron, let's close it off with you. Are you? I know that you're bullish on equities, but from the duration point of view, what do you want to be? Outright long duration, or do you want the steepeners?
So I think right now we're a little bit more neutral in the short-term trading range for duration, and think until we really start to see the Fed underway with respect to rate cuts, you're probably going to be in a fairly narrow band. I think over a longer-term horizon, I do think that duration is incredibly attractive right now, and certainly on a risk-adjusted basis, if you're in this for a 1-2 year time frame, I think now is the time to start to get longer duration, and not just longer duration outright, but also start to term out your duration more into the belly of the curve. Continue to remain optimistic. Equities would look for any type of pullbacks to get long equities. But I think this is an environment, as you start to see the cyclical upturn, you are going to see people pile back into risk if they're sitting on the sidelines. And there's still a lot of cash, keep in mind, that is either on the sidelines or is in short-term duration assets, which are going to be extended.
Okay, ladies, thank you very much. Christina Hooper and Aaron Brown, my guests this morning. Let's get back to Tesla. We've been showing you the price drop, I should say. Quite an amazing drop. We've had the deliveries come through. Ed is side by side with me on set here. The stock is down over 7%. We've missed on the first quarter, and we've not just missed, Ed, but it is a considerable undershoot. Where was the main point of pain in these deliveries?
So first quarter deliveries came in about 74,000 units below the average analyst estimate. We went into this quarter thinking there's concern about demand for Tesla's EVs. Tesla is positioning this as a supply-side impact. They're talking about the diversion of shipping due to the situation in the Red Sea. And also, you'll remember the incident that happened in Germany near their Berlin plant. Tesla is calling this in their earnings, in their deliveries statement, a arson attack. That was something that was being investigated. But there's still a big discrepancy. The production volumes came in about 20,000 units below expectations. The deliveries miss is much wider. The other factor that they're talking about is in my home state of California, in the Bay Area, in the Fremont factory. Remember, the other thing that happened in the quarter was we got an updated, refreshed version of the Model 3. And what Tesla is saying in this statement is that there was a production ramp impact in Fremont as they introduced that refreshed Model 3 onto the line. But it is a big miss. The stock down 7%. And, you know, net-net, it's not clear, was this a demand issue, or do we take Tesla at face value and factor in the impacts of the supply shocks they suffered in the first 3 months of this year?
Well, they've certainly been offering incentives to get people on board, and this is at the same time you're looking at EV. Rivian coming out with slightly better numbers, perhaps, on a relative basis. Thank you very much, jumping onto set and reacting immediately, Ed Ludler, there on the Tesla breaking news. Coming up, oil rises amid tensions in the Middle East.
This is probably the most senior person that's been killed since Soleimani during the Trump administration. And the easiest vector for Iran to respond with would be by attacking U.S. forces in the region. For now, it looks like the U.S. is probably going to be its main target.
The uncertainty sending crude to its highest level since October. Our conversation next on Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but you know, it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, you know, movie-going begets movie-going, right? So when there's a season filled with, you know, good movies that people want to see, you know, I was made to feel pretty optimistic about what we saw in the summer.
Have a lot of levers here. In the past, we might have utilized the Strategic Petroleum Reserve to perhaps adjust the price of oil. We took the SPR down 350 million barrels a couple of years ago and didn't replace it. We are sort of at the mercy of the vicissitudes of what's going on globally. Crude oil last September was at $95 a barrel. We could see the crude oil market retest that. So this move in energy for us is real.
Oil hits $85 a barrel. That's the first time since October. This is the JMMC heads to Vienna, and geopolitics in the Middle East are really taking front and center. Team coverage on the oil story this morning. Anne-Marie Hordern on the politics. Alex Steele on the markets. Anne-Marie, good morning. Tensions rise in the Israeli attack on an Iranian consulate in Syria. How serious is this attack by Israel, and what is the risk of a scaled retaliation from Iran?
Well, it's very serious, this attack, and we've seen that heightened tension even breathe over into the oil market. Manus, what you hear a lot of analysts talk about, what you see in the Israeli press, is that not just the fact that they hit this government building, this consulate in Damascus, but who they hit. Mohammed Zahadid, many people are saying this is the biggest assassination since the United States took out in that assassination of Qasem Soleimani. Iran is already saying there will be revenge. Iran usually does this through proxies, so you want to keep an eye on what's going on in the Red Sea. Does that potentially spill over to the Indian Ocean when it comes to the Houthis, or potentially is there going to be something to Israel's northern border when it comes to Hezbollah? These are the kind of points that we could see Iran have a retaliation, and that is why you are seeing, even though already you had some supply and demand, interesting movements in the oil market, now you're seeing a risk premium because of the geopolitics.
Indeed, we've seen the heightened tensions in the Red Sea, but we have not seen it, as you say, thus far in the Straits of Hormuz. Amory, thank you very much. Let's see what the reaction function is via the proxies. Alex Steele is with me on set. So, Alex, we're seeing this a very immediate response mechanism within the market, $85. We've got JP Morgan writing about $100 oil. But put it together for me, because we've got the geopolitics that Anne-Marie talks about, but we also have supply constraints, an additional level of pressure in this market.
Yeah, and that really comes in the form of, say, Mexico and Pemex. They're going to restrict exports, for example, because they want to fuel their domestic refineries. You have that. You also have ramped up sanctions against Russian oil. That's going to wind up hurting. You have Ukraine using drones to attack some refineries over in Russia. That's going to wind up hurting. And you also have the demand pull. Forget China for a second. European demand is pulling. So you have European demand, you have India unable to access Russian oil like it was, and then you have a big, more of a supply-constrained issue that is supply and demand related at the same time.
So we have the Saudis raising their price into China. We have solid Caixin and PMI numbers in China. We've got the market net longs at the highest in 13 months. You know, as the JMMC meets today, the debate that we have is that we're going to have supply restrictions until June. Are people now going to begin to talk about the possibility of OPEC Plus fading those moves earlier than perhaps we were talking about just a couple of weeks ago?
Everyone's still saying no. I mean, all the research analysts are like, they're going to stick to it. I mean, what is the upside? I mean, what would be the upside in releasing more oil? If they needed it, they really do need it, it's there. What, we have 2 million barrels of oil?
Well, Saudi needs oil at this price anyway,
exactly.
from a fiscal break-even point of view.
Exactly, and they need a lot of money to do a lot of other stuff in relation to oil, right? So they're going to need that price, even though they say they're not going to go to the price. But you do have 2 million barrels of spare capacity just kind of like sitting there. So, I mean, at some point, does the market also pay attention to that? And U.S. suppliers, they may complain all they want about President Biden, but their numbers are really, really strong. Like, the U.S. is the one that's exporting now to Europe. Like, so it's really hard to see why the Saudis would all of a sudden say, okay, I'm going to have lower prices now and pump more.
I mean, you speak to the CEOs here in America. What does this kind of pricing mean for the big beasts of America, for the Exxons, et cetera, here, and for the Permian more broadly?
Money, lots and lots of money. So everyone's going to say that, oh, my break-even's really low. It's 50 to 60.
Not as low as the Saudis.
It doesn't really matter. Exactly. If prices wind up falling, but they're just going to mint cash at this point. You could also make an argument that the higher oil prices go, you wonder if we'll see more M&A. We saw SLB in the market today buying Champion X. That's an oil field services company, so it's a bit different. But the idea is you have higher oil prices, therefore you're going to want to sell. And maybe we think that oil prices will be even higher, and therefore you're going to want to buy. And maybe that winds up triggering more M&A.
Okay, Alex, thank you very much. Alex Steele and Anne-Marie Hordern on the moving oil story. Quick price check for you on Tesla pre-market, down 7%, 7.1%. This is after deliveries not just underwhelmed, but are seriously below estimates, 386,810. The market had it estimated 449,000. They are talking about a phase of production ramp up of the updated Model 3. They're giving lots of reasons on why you're seeing the first significant shortfall in estimates, the first drop since 2020 on deliveries. This is a market which is under pressure without incentives. Coming up, the Morning Calls, Morgan Stanley's Andrew Sliman joins me as we head into the opening bell, discussing the outlook for markets as April gets off to a shaky start, to say the least. That conversation right ahead.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Watch Bloomberg ETF IQ.
Taking a bite out of risk is the spike in yields. 10-year government bond yields up by 18 basis points in the space of 2 days. You look at the highest yields of 2024. My guest in the past 30 minutes says that is an overreaction. The Fed will begin to cut in June. Now, look, the pressure in yields is there, but taking a bite-sized chunk out of the NASDAQ is Tesla. This is one of the worst performing in Mag 7 of 2024, down under over another 7%. There's the 10-year government bond yields up by 7 basis points, nearly 8 basis points. It is Tesla that is the drag. We'll take you through the data on Tesla and their miss on deliveries in just a moment. Your morning calls this morning, this is what the street are writing up. Citigroup downgrades Clorox to neutral, recommending investors move to the sidelines after the stock's recent rally. Next up, Wedbush downgrades Lennar to underperform, expecting a rough summer given the seasonal trends and historic trading patterns. And finally, Bank of America downgrades Petco to underperform from buy, cutting the shares by 2 notches due to mounting competition. Coming up, I've got Andrew Sliman joining me on the market open. Let's see what he makes of this rough and tumble first couple of days in these equity markets. Right here, that conversation coming up next.
Regional sports networks. There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it, Peacock?
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
As we herald the start of April, they may be clapping at the Nasdaq and NYSE, but nobody is clapping for these markets. We're dealing with a rough and tumble of a spike in bond yields. We just had Invesco saying, calm down. This is an overreaction in the bond market, but perhaps not an overreaction in the Tesla stock, which is taking a bite out of the tech story this morning. Equities are on the back foot as we look for a market now that is ahead of the curve in terms of the Fed. The markets are now pricing less cuts than the Fed. That is a new dynamic for 2024. At one stock, I mentioned it, it is Tesla is taking a bite out of everybody's apple this morning. The EV maker suffering its first year-over-year sales drop since the early days of the COVID pandemic. Ed Ludlow is with me.
Manus, good morning. Tesla deliveries really missing the mark. In fact, this is the biggest Tesla deliveries miss versus Bloomberg consensus estimates for what it's worth on record. The stock is down 5.8%, 6%, had been down as much as 7%, a little more than 7% in the pre-market. In its statement, Tesla is talking about supply-side factors during the quarter that account for the lower volumes. Those include having to divert ships because of the situation in the Red Sea, but also a halt production in Berlin. You will remember that there was a fire incident which Tesla is labeling an arson attack, which impacted production in Berlin. Closer to home in Fremont, California, Tesla said that the introduction of a new Model 3, a refreshed Model 3, impacted production ramp. But here's the math that I don't get. The production miss relative to estimates was about 19,600 units. The delivery miss was 62,000 units. So deliveries came in the quarter 86,810. I think many will look at the numbers and say, we read what Tesla's saying about the supply side factors, but we don't buy it because look at the big widening gap between the production level and deliveries. There is a demand problem here. And as we speak to people throughout the day here on Bloomberg Television, I think we need to pose that question. There's been some volatility in the stock this period year to date. So a 6% move is no milestone to write home about. But this is a big miss, a big surprise, and it raises a lot of questions about not just North America, but demand for Tesla's vehicles in other markets like China and Europe.
Indeed. Well, we've managed to bounce by 2% since the pre-market, the first 30 minutes of this show, and where we are now, Ed Ludlow on the Tesla story. And we'll check in with that price as we go through the morning. What do you believe in terms of the cross assets? You've got the bond market spiking by 18 basis points over the space of 2 days. Invesco would say this is a complete overreaction. The Fed will cut by June. And then I have UBS this morning talking about 5 rate cuts going into 2025. That is very different to where the market is now, which is sub 3 cuts. And indeed, June is now the toss of a coin. Crude is up there as we see geopolitical tensions rising. We're at a 5-month high on oil. And Bitcoin down by 7.35%. That is an acceleration on the downside. We were off by more than 10% now from the record highs in March as we grapple with potentially less rate cuts, higher for longer, and a risk-off narrative as we jump into spring. Let's turn our attention to the insurers now. Humana falling as the U.S. regulators didn't boost payments for private Medicare plans, as was expected. Abigail Doolittle has the details. So we're seeing a bit of pain trade for Humana and CVS. Abby, take it away on Humana.
We certainly are. Humana down 10%, the worst day since January. And that, of course, was when they put up a miserable quarter and really had to cut their profit outlook, having to do with the fact that more Medicare Advantage enrollees utilize the plans. That connects to the Centers for Medicare and Medicaid late yesterday, saying that the payments to Medicare Advantage plans will increase 3.7% in 2025. That amounts to $16 billion, but it's much less than what the street and some of these companies had been expecting. In fact, it's also what they said in January. Despite the fact that these plans are being used more, that was why these companies lobbied to the Centers for Medicare and Medicaid to increase the rate more, but it simply didn't happen. Mizuho saying that the 2025 final effective rate, excluding assumptions of risk score trends, equals a decline. Wall Street had been looking for an increase of 1 percentage point. Right now, Manus, Humana on the year, including today's decline, down about 30%. That is heading to the worst year since 2008. Understanding that it's early in the year, but nonetheless, that's the degree of the selling pressure that we're seeing on this confluence of news.
Yeah, a couple of salvos across the market's bow over the past 24 hours. Abby, thank you very much. Let's pivot to entertainment. Disney investors will vote on the effort by the activists to reshuffle the board. We've got the Wall Street Journal reporting that Nelson Peltz is losing that battle so far. Katie Greifeld can give us the update. So a battle is going to ensue on this, isn't it?
Absolutely. Potentially the final chapter here of Bob Iger versus Nelson Peltz. Of course, Disney's annual meeting is tomorrow, April 3rd. And at the center of this dispute is really two things. You have streaming and you have succession planning. Let's start with streaming, because Bob Iger, he promises that streaming profit is coming in 2024. Peltz, of course, pushing for board seats in an attempt to really stem those losses and also revive subscriber growth. And also at issue is succession planning. Remember that Iger, he extended his contract with Disney last year. He returned to the company in 2022, and who eventually replaces him is unclear at this point. And like you mentioned, you have the Wall Street Journal reporting that Disney is leading in its proxy fight with more than half of the votes counted thus far, but investors, they're still casting votes and they can change them. You take a look at Disney shares right now, they're down mildly at the moment. They're up 35% in 2024, but still about 40% below their 2021 all-time high.
Bit of a reflection on the belief in Iger over everything else. Katie, thank you very much. Let's turn to the consumer space. We've got Calvin Klein, the owner, PVH, falling. That's after the company gave full-year sales guidance that fell short of expectations. Isabel is with me. Isabel.
Hey, Manus, PVH shares tumbled 21% in the open. That's the biggest drop since March 2020, and shares are now falling further, down around 23%. So the fourth quarter results were good, but as always, it's an outlook that spook investors, especially the first quarter and the full-year outlook. So PVH is a company that owns Tommy Hilfiger and Calvin Klein, and the company said it expects revenue to decline 6 to 7% this year, and that's compared to the 2% increase we saw last year. And of course, some of this expected decrease stems from the fact that they acquired Heritage Brands, which is a women's innerwear brand. But still, the company also said it's generally the difficult, tough macroeconomic environment we are in, especially in Europe. We have Evercore saying margin outlook for 2024 is, quote, significantly disappointing. And we have JP Morgan saying that declining growth in Europe is worrying and also cut its price target. For now, PVH is really working on strengthening its brands in Calvin Klein and Tommy Hilfiger, as we know that those two have lost momentum with shoppers in the recent years. For now, year to date, shares are up 22%, but it's looking like a bad day. Now shares are down 23%, Manus.
Isabel, thank you very much. My guest this morning is from Morgan Stanley. It is Andrew Sliman, and we're taking a look right now. Obviously, Tesla is our hot story, our hot stock. This is the Mag 7 year to date. Tesla is the laggard, down 33%. Let's just get an opinion on that. Mr. Sliman, good morning. We're being attacked on all fronts here, aren't we? We've got Tesla under pressure. I mean, this is brutal, down 5.5%, missing on the deliveries. We've got yield spiking by 18 basis points. Just a very first reaction to the Tesla news flow. Idiosyncratic to Tesla or something more malevolent?
Well, I think it's a good thing for the Mag 7 to be bifurcating based on fundamentals. If you look at the ones that are the winners and losers this year, it's all about fundamentals, and that was not the case last year. So overall, I think it's a healthy sign that the stock prices are reflecting what's going on in the fundamentals. And, Tesla certainly, stock price and fundamentals seem to be going together.
So the bifurcation, I mean, you're going to hear people screaming from the sidelines, buy the dip on Apple, buy the dip on Tesla. The bifurcation will have ramifications in terms of performance for the rest of the year. I know that you've got a view on tech, and it doesn't necessarily coagulate around the top of the Mag 7, but you do like exposure in certain areas. How do you play tech?
Well, look, what's wonderful about this, what's happened recently, is if you think about the rally in the first quarter until early March, it was only a momentum, AI, weight loss drugs. It was all the same stocks. And then the market, those stocks kind of ran out of steam, but instead of pulling the market down, the market rotated into other areas like energy, financials, materials, industrials. That's a very good sign that people are looking for other areas to buy. And so I think, yeah, you want to own some tech names. I like some of the semiconductors that will benefit from the CHIPS Act. But I also like the cyclical areas of the market also, because I think this is not growth or value. I think it's a combination of both that you want. Now, I will caveat all this minutes by saying, look, last fall, when the conflict in the Middle East broke out, oil went down. And everyone asked me about geopolitics. And I said, I don't know, but I always watch oil. Well, oil is spiking higher. That means the concern by equities towards what's happening geopolitically is increasing. And that's something that we need to watch near term.
I mean, this oil price is rising. There we go. You're talking about the dangerous concentration and that movement in momentum stocks on wine, but it didn't have a brutal effect. The spike in oil this morning, let's talk a little bit more about that. How much of a challenge do you think that then becomes for the Fed? We'll talk about the Fed more broadly in a moment, but that oil spike, it's certainly not going to be welcomed by Jay Powell, nor the White House for that matter.
Without a doubt. Certainly the White House. You don't want to have people, being forced to fill up their gas tanks at higher prices right before an election. Yeah, I think it's a problem. My base case is always, look, I think it's better for equities that the Fed doesn't cut because they're sending a message that economy is strong and they can be patient. I think that's a good sign. I'd be a lot more nervous if they were, hypothetically speaking, they were cut tomorrow. I'd get really worried that they see something that we don't see. But if they're not cutting because oil prices are higher, that's an inflation problem. And that's a concern. We'll have to see how this plays out. Look, I've been in the business a long time, and I've heard the secular thesis on oil forever. It never pans out that way. It rolls over eventually because higher prices always brings out more supply. We'll have to see, but near term, this bounce, I think, is a concern for equities after a very good run.
Well, here's the issue, isn't it, about where we are with rate cuts. Right now, we have the market assuming less cuts than the dots. Who'd have thought that we got there so quickly? So now we're sub 3. June has been shredded to the toss of a coin. We have oil lit up like a Christmas tree. I'm sure we'll get more notes at $100 oil in our inboxes, both of us. How would you react if there were no rate cuts this year, Andrew?
Well, again, I think they would be forced to cut rates if the economy weakened. So if you told me at the end of the year there were no rate cuts, my first reaction is, well, that means earnings estimates for next year are going to start the year somewhere, 275, 280. If you told me that they were cutting 6 times, I would go, oh my God, there's no way earnings are going to start the year at 275. So again, I think a patient Fed validates that the economy is strong. That's better for equities because as you think about where will the market end the year, it's going to be priced off of what is the forward earnings estimate for the S&P. And right now, next year is in the 275, 277 range. And that validates upside in equities. But if they cut 6 times or whatever, then that gets me worried, and then it's tougher to see a lot of upside in equities.
Let's put Morgan Stanley against UBS. I had UBS on this morning. They said 5 rate cuts in 2026. The fatter tail risk is a slowdown in growth. The fatter tail risk is a slowdown in growth, a material slowdown in growth, because we've extrapolated too far. Now, the other side of that trade is, of course, China's rebounding in growth. Caixin is strong. ISM in the US is strong. And we are dragging ourselves by our bootstraps out of recession in Europe. Does growth hold up? How do you look at growth, and do you play that cyclically? Is that, I want to deploy more to cyclicality now because of perhaps this floor in growth?
Yeah, that's a great question. So look, in theory, as rates go up, inflation goes up, you want to play cyclical stocks, right? But if the market thought that the Fed was going to overstay their patience, you would see these stocks roll over, even though a little more inflation's good for them. And we're not seeing that right now. The best performing sectors the last 4 weeks have been the cyclical sectors. So the market is sending a message here that they think the economy can withstand Fed being patient. We'll have to see if that continues, but that's the message the market is sending. And so I think you do want to play these cyclical stocks because there is quite a bit of spread of valuation still between the cyclicals and the growth stocks. And what we're hearing from a lot of our cyclical companies is they have pricing power. They're raising prices, especially in the materials area, and that's good for the earnings.
Okay. Andrew, thank you very much for joining us. That is Andrew Sliman of Morgan Stanley on the markets. Coming up, EVs in focus. We've been tracking the Tesla price from the start of the show. We're down, as you can see, nearly 5.5%. Rivian down 6% as well. They unveiled their first quarter auto sales. We're going to pack it all in just a moment on the EV ride.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors, including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Power, money, culture. as Linda Amin tells the story of Asia's rise through the people who are helping to shape it. This week, navigating the challenges of AI, shifting generations, and talent retention, Recruit Holdings CEO Hisauki Idekoba opens up about the future of employment in Japan and around the world.
More workers don't want to do tough jobs. They prefer to have remote work or flexibility.
Latitude, encore presentation this weekend, only on Bloomberg.
Well, Tesla is suffering its first year-over-year sales drop since the early days of the pandemic. Meanwhile, you've got Rivian getting a boost after building more EVs last quarter than Wall Street expected. Both stocks are under pressure this morning. Craig Judell is back with me. We've gone from the preview to the finale, Craig, here, and the finale is brutal in terms of deliveries. Did Tesla play the wrong game by delivering or trying to go for the incentives?
I mean, they really threw everything at it this quarter in terms of, perks, supercharging miles. They threw temporary discounts out there. They even tried to advertise, which is something that Elon Musk, has made a name for his sort of detesting of advertising. They even tried that out in a more concerted way. For them to come this far short of consensus is the biggest miss relative to the average estimate that we've collected in data going back to 2017, 2016. So, this is really a pretty remarkable report. It's hard to find a silver lining here. You also had sort of accumulation of inventory and that they produced quite a bit more than they delivered. And so a real question as to whether or not this sort of whether this pricing discipline that they tried to put a face on this discount of $1,000 being temporary, something that would lift at the beginning of this month. It seems like it's only a matter of time before that discount it sort of is brought back, perhaps, and then some.
What is the bigger issue here, Craig? Because you've had BYD snapping at Tesla's heels in China. You've got this, these reasons that they're giving. They had the Red Sea outages. They had problems at their factory in Berlin. What is the problem? An oversupply of better designed EVs or a Tesla-centric pricing problem?
I think we have to separate the two to some degree, just in the sense that BYD does play at such lower price points with a lot of its models, and it has so much more of a lineup to work with. To Tesla's credit, they are able to get so much volume out of so few vehicles, and that really, on one hand, sort of is a positive for them in terms of cost. It is, sort of unusual in the industry to be able to have so much volume out of just a couple of models. On the other hand, we're seeing this sort of, way that is a double-edged sword, in that if you only have a couple of models to offer and you don't keep those models, regularly updated, they're going to get tired, and consumers are going to, be interested in something new and fresh. And so we're seeing the limits of that strategy for Tesla.
What do you think Musk does from here? I mean, he can be quite Machiavellian in the kind of his approach to dealing and grappling with, a tough day in markets, a tough day in the stock price. He's not going to instantaneously react, we don't think, but he's got to clear this inventory. How does he deal with this situation?
I think that's a really interesting question, and one of the things that you notice if you kind of spend too much time on Tesla's website is that on the sort of front end, if you want to sort of custom build your vehicle, you are quoted a certain price. Interestingly, in the last year or so, as they've so aggressively cut price and had some demand issues, they've moved to this model where you can order cars out of inventory, and those tend to be much lower price than otherwise. And so whether we see pricing deteriorate in a way that's less apparent for analysts, for investors, and whether that just adds to pressure on margins, I think that's going to be something that is going to be the focus in a few weeks when this company does report first quarter earnings.
Okay, well, they've got more headwinds coming, haven't they? They've got a new Cybertruck. Well, they've got Cybertruck headwinds coming, I should say, with Xiaomi with their new EV SU7. So the headwinds don't stop. Craig, great coverage through the morning, you and the team. Craig Trudell on the Tesla story. For some price action this morning, let's get back across to Abigail. She's got a lot to get through. Abby.
Yeah, absolutely. We have the S&P 500 down 1%. That is the worst day in about a month. At the lows, the worst day since the middle of February, down for a second day in a row. Not surprisingly, most sectors are lower, led by healthcare and that insurance news, down 1.6%, that the Medicare reimbursement rates won't be quite as high. Tech also down 1.6%, consumer discretionary on Tesla, so not a lot of places to turn. One bright spot, though, you can see energy there, up 0.9% in sympathy with oil. Oil right now rising at its highest level, essentially, or in the range of since the summer of 2022, and this, of course, on those recent OPEC plus cuts, plus rising geopolitical tensions. So you can see the oil service sector index, a subsector, up even more, Manus, up 1.7%. So at least there is one bright spot on the day.
Absolutely. All hail the oil and the oil sector. Abby, thank you very much. Coming up, market moving events for your diary. It's a lot of Fed speak on the slate, right here on Bloomberg.
Names in tech are on Bloomberg.
There is a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to be based on Gen AI on the phones. We're optimistic that we could start to see devices as early as this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
Make sure you're logged in. This is what you need to keep an eye on. Joel stayed at the top of the hour. Fed speak, Williams, Mester, Daly all hit the tape. Wednesday, ISM services. Then we roll to Thursday and the jobless claims. Wrapping up the week with the jobs report on Friday. We expect 200,000 of a growth. The bond route is going global, from the United States of America to Germany and the UK. Perhaps the most malevolent moves in the UK, up 16 basis points, 18 basis points in 2 days in the United States of America.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Kaylee Lines deliver news, insight, and analysis from and about politics' biggest power players.
Let me just start with, this is not the first time we've heard this argument.
I mean, this is going to be an ugly, ugly year.
Balance of Power, live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. Alex Steele, Paul Sweeney. This is the Bloomberg Intelligence Program. We focus on companies. We focus on stocks. We rely heavily on the 400 investment professionals of Bloomberg Intelligence. They cover more than 2,000 companies, 130 industries on a global scale, and we lean heavily on them. And then we're going to do that again today with Ira Jersey. He's a chief U.S. interest rate strategist at Bloomberg Intelligence. This Fed, I'm looking at rates going higher and higher here. The 10-year's up another 7 basis points here. What's Ira going to tell us about rates? Then we're going to check on Shelby McFadden, investment analyst at the Motley Fool Asset Management, get her markets call. Geetha Ranganathan joins us, Bloomberg Intelligence. She covers all the media companies. Disney. There's a lot of dissonant shareholders there, but I think the board seems to be lining up in back of management. We'll see what that means for our friends at Disney. But right now, let's kick everything off, as we do, with Mr. John Tucker, a Bloomberg Business Flash.
All right, guys, yes, we are data dependent. Let's start with the data. The job opening labor turnover survey. Some weakness in the labor market, but these are still pretty good numbers. Job openings, 8.75 million for the month of February. That is a little more than the survey of Bloomberg, of economists surveyed by Bloomberg, and revision downward from the previous month. And as a result of that, we're looking at Treasury yields right now. The 2-year, that is unchanged right now at 4.71. The 10-year is still 7 basis points higher, 3.85 there. And more Treasury yields, again, pushing higher. Stocks lower at this point. Traders repricing lower the odds of Fed rate hikes. Risk assets aren't getting any help from disappointing delivery numbers from Tesla and those shares this morning. We'll take a deeper dive in a few minutes. Right now, 5.2% lower. Meantime, Troy Gajewski at FS Investment says the stronger data that we've seen recently may actually push stocks higher.
Well, for risk assets, it still continues to be a good thing over the medium term in that stronger economic growth leads to more revenue, leads to lower default rates and credit.
And on a technical basis, you have shares of Apple teetering close to a key support level. Short sellers have been pouncing on shares of Apple. Right now, they're down 0.5%, $169 for Apple shares right now. As far as the overall market, the S&P 500, 47 points lower. That's down 0.9%, 51.96 on the index. The Dow Jones Industrial Average is down 425 points. That's a decline of over 1%. The Nasdaq 100, 236 points higher. That is down 1.3%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, John Tucker. I got these JOLTS numbers.
All right, so what I do on the JOLTS numbers is I kind of go back, I graph it, and go back to the beginning of time, which for this data series is like 2000. It seems like the average is like 5, 6, maybe 7 million. I mean, you've got 8.75 million people that aren't working with these job openings. What are they doing? Is this the new normal post-pandemic?
Well, but this isn't them not working. This is people, like, their job openings. Like,
Right.
This is companies being like, we need these workers.
So where are they? I think they're all sitting in Starbucks. That's my thing. They're all sitting in
but it depends on what jobs there are. Like, are you going to go sort of do construction work? No. So, like, if you left here, what would you do? Okay,
can't
that's
swing a
true.
hammer.
So sorry. Okay. Okay, he wouldn't work in retail. Okay.
I think you had it right with construction.
Yeah, but so I think that there's definitely this big labor mismatch.
Yeah,
Which
exactly.
is why it'd be interesting why the household survey on Friday has been very different than the overall jobs market. So you kind of wonder where that disconnect is. But super solid, and that's why you're seeing back-end yields continue to rise. So lots of fun stuff coming out too. You didn't mention oil. No one mentioned oil.
I know.
Guys.
Yep, you're right.
What's going on with that? We're looking at $85 oil is the path of least
And
resistance
Mike
going
McGlone
higher.
at Bloomberg Intelligence still maintains it's going to 55 or thereabouts.
He does say he was early. He does say he was early and continues to be early on that call. Let's get more here with Norma Linda as she joins us from Bloomberg News, looking at all the individual stocks, of which there are many actually moving in this pullback we supposedly all wanted. First up is Tesla.
Yes, as John mentioned a bit earlier, Tesla is lower, slumping as much as 6.7% after some sour first quarter deliveries, dropping 14%. This is below what the street had been expecting, below 14%. And those deliveries were quoted at 386,810. Now that's against an estimate of 449,080. This could cause Tesla to really blow through several milestones, may make it drop below its $500 billion mark. And investors were really lowering their expectations as they were thinking about deliveries coming into this print. But of course, we do know that this is a huge blow against the company, especially as it's already been struggling. And this is its first year-over-year sales drop since the early COVID days.
Yep. We'll see. We had Ed Ludlow from Bloomberg News just in here moments ago. He just leased a Tesla last week.
Oh, wow.
And so he said he did his part, but he said this is a really, obviously a big miss. We had Gene Munster on, who's been a longtime Tesla supporter on, and he was really disappointed in these numbers. The Whisper number was much, much higher here. So what the company did not cite, what they did cite is supply side issues. The Red Sea, we've had something at a Berlin plant. What they did not say was any demand issues. And of course, that's what the market is concerned about. Again, the stock is off 33% year to date.
Yeah, clearly the market's not buying that. They're
No,
like, oh,
not at
just
all.
supply. Oh, it's all good. Really, no problem. You're also looking at PVH. So that is a retailer like Calvin Klein's, Tommy Hilfiger. See, a good example of where you wouldn't be working.
Right. Well, I could do that. I'm a sharp dresser on occasion.
No, you are. But like, really, you're going to be like, Alex, those shoes look great on you. Anywho, that's down a huge amount.
Pretty big percentage drop here. Those shares are sinking as much as 25%. Now, this ticker is PVH, and as Alex mentioned, this is the parent company of companies like Calvin Klein and Tommy Hilfiger. This is its worst drop since 1987's Black Monday. It reported a weaker than expected full year sales forecast and blames difficulty on macroeconomic backdrops in Europe. It expects revenue this year to decrease 6% to 7%, and that's compared with a 2% increase last year. So really a surprise here, and those shares are really, really falling here.
Yeah, that's interesting. I mean, wasn't expecting that here. I mean, that's not an indictment on retail, is it? I can't imagine.
Well, it was definitely Europe, right?
Yeah, I mean, it was
a lot on Europe, but even sales in the U.S. were a touch weaker too.
Exactly, but they're really focusing on Europe here. That's where they're really citing the majority of the pressure.
All right, let's go to Humana. So this is really interesting. All the insurers are not, yeah, you tell us the story.
Well, it's really important here to make the distinction between, private Medicare and then public. So, of course, public, we know we pay in our taxes, but here we're looking at a lot of health insurers and we're looking at Medicare Advantage. Now, that is the private side of things that the government pays a set rate fee per person for. Now, Biden's administration has stunned the industry by choosing not to boost payments for private Medicare plans. It's almost 0.2% cut. So it's a bit smaller, but I mean, I do think that this is something that really has investors upset, especially as they weren't expecting this to happen. According to JP Morgan, this is the first time in 10 years that have had final Medicare rates not improved from regulators' initial proposals.
All right, well, the good news is right around 11:05, we're going to have Dwayne Wright. He's going to join us. He's Bloomberg Intelligence. He's a health policy analyst. He's based down in Washington, D.C. He's going to join us to break all this down. Mark, thank you for that because we've got people who do this stuff for a living for Bloomberg Intelligence. So we're going to talk to Dwayne Wright at the top of the 11 o'clock hour.
All right, Nora, thanks a lot.
Cool, great stuff.
As always. All right, let's get to the bond market here because you're looking at back-end yields continuing to rise. It's after a pretty solid sell-off yesterday as well. The 10-year yield up by about 7 or 8 basis points. We're looking at the 30, the 10. They're all at the highest level now that we've seen so far this year as stocks wind up dropping. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist, joins us now. Ira, how do you square the data that we continue to see, ISM manufacturing, the JOLTS numbers, even factory orders? Like, how much higher can we go in yields before things start to hurt?
Yeah, well, obviously they're going to start to hurt risk assets probably sooner rather than later, just because the expectation has been that the Fed was going to cut interest rates. And as we keep on getting these better and better numbers, we're just going to either do one of two things. Either we're going to price out rate cuts altogether, or as you've seen recently, is we're just going to push out when those cuts are going to start because the economy is just not slowing. So the higher yields that you're seeing, I think, in the back end of the curve is just a reflection of the idea that if the Fed does ultimately cut, it might not cut that much, number one, and number two, that the cuts are going to continue to be priced out. What's surprising me about this move is that a lot of it's coming in the back end of the curve. So like you mentioned, 10-year yields, 30-year yields. 2-year yields have gone up, and at around 4.7%, they're still pricing more or less for 3 interest rate cuts this year. I think that that's probably the next nut to crack, where you really need those 2-year yields to go up toward 5% in order to get 10-year yields above 4.5 for sure.
Is there a scenario, Ira, in any of your crazy models that you and your team have there down in Princeton that says no rate cuts in 2024?
Good one.
Yeah. So there actually is, and I think that that's a case that you can't completely dismiss, especially when you see the strength in the data as powerful as it has been recently. So unless you wind up getting a more significant slowdown in inflation amid this very strong growth, which seems less and less likely as time goes on, then the possibility that the Fed doesn't cut interest rates at all this year and maybe into next year has to be on your radar. And I think and one of the things that you've seen in the rates market, LIBOR is no more. So now we use something called SOFR, the secured overnight financing rate. Well, so most short-term interest rate bets are put on in SOFR futures right now. And if you look at the options on those futures, there's now about a 20% chance being priced that the Fed does nothing or even maybe hikes interest rates before the end of the year. And I think and that's a significant shift from where we were in mid-February when we were pricing only for cuts. It was a matter of how many.
That's interesting. Yep. So does the fact that we're seeing more move in the back end versus the back end versus the front end, what does that tell you about the potential hike or no cut scenario?
Well, I think a big part of it is people were, I think, edging long. So, a lot of people, including our own Bloomberg economics team, thought that we were going to start to see a significant slowing in the economy now. So they had gotten long interest rates, had gotten long treasuries, and were ready for a rally. So I think one of the reasons you're seeing the back end underperform a little bit is just people getting out of that risk. Once those positions are cleaner, then you wind up with a scenario where people look at the fundamentals and say, okay, what's the actual fair value for 10-year yield and 2-year yield? Right now, everyone's kind of in risk management mode saying, okay, we're too long risk given the economic environment. Let's right-size our risk, and then we'll determine whether or not there's some value here or not value there. So I think that's the mode that we're in right now. Plus, remember, we're early in the quarter. I think some of the positioning last week had to do with month-end rebalancing before people put out their quarterly or semi-annual fund reports and the like. So some of this maybe is that people wanted to be long going into quarter end, and now they don't see a big reason to be long at the moment. So that's one reason why people are getting out of risk. And it's easy to do when you see decent data like we've had the last 2 days.
So the 10-year IRA, I've got it at 4.38 here. Is there a technical kind of level that I need to be watching for? Like if it breaks above 450, then it can go significantly higher than that. Is there any technicals here that you're paying attention to?
Yes, and we just broke a very important one, actually. So 4.35% was the level that we were watching the last 2 months. Now that we're above that, we'll be targeting 4.51%, call it 4.5% for round numbers, and then above that is 4.7%. So we really have a little bit of a gap here, another 10 or 12 basis points. Interestingly, when you look at some of the momentum oscillators, I was just looking at this with Chris Kane, one of my other Bloomberg Intelligence colleagues, who's a chartered market technician, so he's one of those people with a 3-letter acronym after his name and looks at charts all the time. So he and I were actually just talking about this, and the relative strength index and some momentum oscillators aren't yet at extreme levels to think that the sell-off is over near term. Now, you get another day like we have today, then those momentum indicators will be in extreme levels, and you can maybe think of a little bit of a pause in the sell-off for a little while. But we're not there quite yet, so we could see more volatility. When we have some Fed speakers at 12 today, if they sound a little bit more hawkish than Jay Powell was last week, then certainly you can wind up probably adding on to some of the market angst right now.
Some feels like an understatement. We got Bowman speaking at 10:10. You got Williams speaking at 12. Messer speaking at 12:05, and Daly speaking at 1:30.
Why did they do that? Did they get paid to speak? I mean,
That's a good question. Why? Yeah. So what are we going to learn from like a million different Fed officials at the same time?
Well, so a lot of the Fed speakers, these lunches and these different activities that the Fed presidents, the regional Fed presidents or Fed governors do, a lot of them are scheduled months and months in advance. They're part of their job is to be out in the community, listen to people, let the public know what their thinking is, how they think the economy is going to be, what monetary policy is going to be. It's part of their job. It's funny. People always ask me, why do these people go out there all the time and make all these comments? They've actually always made these comments. It's just when Alan Greenspan was the chair, we didn't pay attention to anyone except Alan Greenspan. and more recently, things have been more democratized within the Federal Reserve. So therefore, all of these Fed speakers get more attention, maybe than they deserve. But it is helpful in the fact that now we know what the distribution of the Federal Reserve looks like in terms of who thinks that interest rates should be raised, who thinks that they shouldn't be raised, who thinks they should be cut, right? So there's a variety of views, and having those views, I think, does muddy the waters a little bit. But in aggregate, though, these discussions have always happened. Just we just didn't pay attention, and now that we do, we wind up having more headlines and maybe generates more volatility. The Fed maybe could pull that in a little bit and basically say, hey, don't make a lot of monetary policy comments. But I think the cat's out of the bag now, and we're just going to have continued Fed speak that's going to be very important to markets on a minute-to-minute basis.
All right, Ira, I'm all in on the men's and women's Final Four, so I'm not really paying attention to soccer. But if there's one match I need to follow in your world of soccer, what would it be?
Oh, I think Aston Villa, of course. My Villains have had a big win over the weekend, a 2-0 victory, so we're moving up the table. I'm going to watch the Villa match this weekend for sure.
All right, Ira Jersey, good stuff. We appreciate it as always. Ira Jersey, Chief U.S. Interest Rate Strategist, Chief Soccer Strategist for Bloomberg Intelligence. bringing it to us from Princeton, New Jersey. So I don't know. I'm all in on the Final Four. The women's had great games.
You're
last
looking at me
night.
for sports, dude. What are you doing?
Women's sports. I'm just saying, I'm all in. And this is the first year I've really been like paying this level of attention. I mean, Michael Bard, the business of sports, he's always in on it, but that's, I'm kind of paying attention to it. So
Final Four, yay. Women,
yay. There you go.
That was better than an NBA game, I would say, last night.
It was. I mean, it's just
More
super competitive, and that's all you want. And they got a great Final Four: UConn, South Carolina.
What's
North
the pay
Carolina.
scale now? Male and female athletes.
Non-comparable. It's just not comparable.
It's not even there.
No.
Do you think that changes now after?
No.
Mm.
No, but it gets better. I mean, the women are getting more and more and more, but so are the men, and so it's just getting kind of crazy out there. So we'll see. But anyway, got the Final Four to look forward to this weekend. That's coming up. S&P 500 off 1.1%. This is Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
rate cuts. And then you have Tesla. They're not helping markets today, suffering the first year-over-year sales drop since the early days of the COVID pandemic. Shares of Tesla right now 5% lower. And worst performing stock in the S&P 500 right now, that is Humana. Those shares, they were down as much as 13%. Health insurers won't be getting the reimbursement from Medicare that they had wanted. Right now, the S&P 500, 53 points lower. 1% decline there, 5190 on the index. The Dow Jones Industrial Average down 415 points. That's a 1% decline. The NASDAQ 100, 269 points lower. That is down 1.5%. As for yields right now, the 2-year, which is more policy reactive, that is unchanged, 470. The 10-year, the benchmark, that's 5 basis points higher. That's right now at 436. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, John Tucker. So the S&P, as John was just saying, is off by about 1%. Volume is actually pretty high. It's like, is this the sell-off we've all been waiting for, right? The S&P drawdown so far this year has only been barely 2%. So do we get there? Let's ask Shelby McFadden, investment analyst over at Motley Fool Asset Management. She joins us now in the Bloomberg Interactive Brokers studio. Shelby, is this the sell-off we've all been waiting for? Is it a buy the dip kind of thing? What do you think?
You know, unfortunately, I'm going to err towards no, and I'm really heavy on that, unfortunately, right? Because we know these valuations have just been so rich. And when you're looking at the long term, for your investment strategy, you know, it's easier to say, okay, we'll just sort of hold out, it's all right. But we do get really excited about some of those buying opportunities, either to add to current positions or to be able to enter new ones. So I think when we look at what might cause a dip, we don't yet have those factors being quite as strong. I think we might need a couple more quarters to see at least what might happen with interest rates being a sort of force to push the market down a bit more.
So do you need to see higher rates? Do you need to see weaker earnings? What do you think what do you think will push this market down when and if we do get that correction?
You know, I think it could be a combination of both, and it really, in some ways, depends on the sectors, right? So when we think about tech, we do know that those being, you know, higher duration, very sensitive, that interest rates are going to most likely affect the tech sector quite a bit. And then on the other end of that, small caps as well. We've seen the sort of damage that can be done to valuations to both of those groups. So that's one sort of focus. And then outside of that, we do, again, need to see the change in those fundamentals. So in some of the companies, we're seeing that the valuations are just stretched for optimism, for wanting to hold on.
At the same time, though, if interest rates are going up, and I say interest rates like the 10-year is going up because the economy just firing on all cylinders, does that change the reaction function to, say, small caps or big tech?
In some ways, yes and no. So if the economy keeps firing, we might sort of have a situation where trading sort of shakes out those who are not interested in holding out and seeing whether there is more or less volatility than they've expected when it comes to things like small caps, especially due to that thinner trading volume. But when it comes to the larger caps, there's a chance that we kind of just settle out at a higher clip, that we end up with what is the Fed's fear, is that we just step up in inflation and in valuation basis. So it's one of those things where, unfortunately, it's a little bit of a seesaw, and we all have to sort of wait for it to shake out.
One of the names on your list is CRH. It's a Irish company, which is why I'm interested in it. Building products company. Talk to it. Is this an Infrastructure Act kind of play for you guys, CRH?
Yes,
Which is
so
the ticker?
When we entered the position, that was one of the reasons that we had piqued some interest. Another was that they were going to be moving their listing from LSE to the New York Stock Exchange and going ahead and starting to do their gap reporting. So realizing getting a little bit more bang for their buck, starting to get that multiple that they were looking for, and of course the fact that the IIJA was going to bring forward some of that cash flow for them. On top of that, before the infrastructure bill, they were already the #1 provider in North America for asphalt, ready-mix concrete, cement. So they were sort of this sleeper agent in all of the repair and just keeping up with the roads and things like that, apart from any new build. So it's a company that is not thought of a lot, but they're really king in what they do.
How is the booking for that all working? Because I've been struck with, say, the infrastructure bill, for example. Like, we all were expecting like a huge wave of money and orders, and like the orders are there, but like it's not coming the way we were all expecting in the middle of like a structural shift. The industry is still cyclical.
And you're absolutely right. And what we've seen, and what management has mentioned is that they're getting stretched out a bit. So the contract money is coming through, but it's not coming through, 24, 25. It's 24, 25, 26, 27. And they're not necessarily being canceled, but they're being taken in slimmer chunks. And they have to get finished, but at the end of the day, rates are still high. And so construction can still be a bit more expensive, especially when you're talking about new as opposed to repair and remodel. So yeah, that contract stretching is absolutely a real phenomenon there.
So you've got a real estate company on your list of stocks. You guys are looking at it, and that's got to be a dicey place to be. Alexander Research Real Estate, yes. ARE is the ticker symbol. Talk to us about that company, because I'm nervous about anything that's got real estate in its name.
And I think that's completely fair, and I think that a lot of folks would think that on first hearing as well. What we're really interested in with Alexandria Real Estate is, one, the valuation. They've gotten crushed because why? Real estate.
Yeah.
But what sets them apart is not only their really deep bench on management that we like, they've got an outstanding return for investors when it comes to cash delivered back. They really just pump out cash as a REIT there. And also their focus on healthcare and life sciences. That's really what we're hinging on when it comes to our thesis for Alexandria Real Estate. And because of that, they're also just less exposed to that office that is really crushing a lot of the REITs right now, because they're not having to deal with that pendulum swing of overdevelopment of offices, making them that sort of second home for employees, and then employees sort of saying, I'd like to never come back, thank you very much. So when we have these new advances in sciences, they need more buildings. And that's really the crux of the thesis for Alexandria Real Estate there. So if they can keep delivering on cash and keep on that train, it's a great investment for us.
So you guys obviously have done the work on the real estate space. You're based down in the DC area, right?
Yes.
Are federal employees, are they back to work 5 days a week, 4 days a week, 3 days a week?
I knew you were going to go here. 100% knew that.
What is that?
It seems to be a bit agency by agency at this point. From my understanding, friends of mine that I know are more about 3 days. When you're looking at the contractors, many of them are fully remote now. So it kind of depends. If you work for a 3-letter, you're probably in 4 or 5 days a week. If you work for a different agency, you might be more flexible.
I do notice a difference though. Like, not being in the office, you 100% miss out on those like random conversations that all of a sudden like mean something in a few years or even 6 months.
But I think that ship has sailed, though. I
think you're right. I just don't know like what the career path.
But if I were investing in real estate,
yeah,
that would be my base case. Like occupancies, whatever they are today, that's what I'm going to model out.
Yeah,
they're not going to get any better. I don't think they're getting any worse. That's what I would model out.
And the same idea at Bloomberg is like you have a desk, right? But if you could also go to any desk and it would be the same experience,
Absolutely.
like that kind of idea versus sort of here's an office kind of thing. You also like Meta. That stock is up a whopping 130% in the last year. You still like it at these levels to buy?
Yeah, so at this point, it is a little bit rich on the valuation, so we do watch out for any sort of opportunities. And the thing about these tech stocks is that because they can be a little bit volatile, you just watch every day and sometimes you do get one. But what we like about it is that their say-do ratio, as we call it on our team, has been high.
What's that?
The say-do ratio. So they say they're going to moderate costs. They say they're going to go ahead and sort of leave behind any investments or capital allocation that's not paying off for them. And over the last 18 months or so, they've done it. We've seen that improvement in their margin. We've seen it starting to come through on cash flow. We see that management's getting more serious about tangible ways to handle AI. And also when we look a little bit forward, we compare them to another advertising competitor. Meta's got more retail media exposure, which in these times, consumers turning a little bit more to goods as opposed to services. So when we look at the advertising market in search, for example, that's going to lean a little bit towards services. As goods are coming down more, retail media has an opportunity to stand out. So Meta is definitely a little bit more poised in that regard.
Yeah, that went from being, since its inception, a top-line revenue growth story to really over the past 2 years to being a cost-cutting story.
Yes.
And that's what worked. I mean, I didn't see that coming, but they actually did.
They did it.
What they said.
Yes,
say-do.
Say-do.
I learned something. That's so cool. What other company has a good say-do?
Ooh, who else has got a good say-do? That's a great question.
Who has a bad one?
Well, I don't know if legal wants me to do that. But
that's fair. Fair enough.
But, I would say we could probably throw Apple out there for having a decent say-do. And in some situations, I think what ends up happening is their valuation gets sort of bounced around like a hacky sack because they say that they're going to do very reasonable things, and sometimes that's not enough for the market.
Right.
Mature companies tend to say that, and when you want that intense growth, and they say, well, we're actually not there. We're kind of giving cash back, and we're doing responsible allocation. They're saying it and they're doing it, but it may not be what the market wants to hear.
Yeah, the market wants to hear, don't worry about China.
Yeah.
China's fine. Don't worry about
Yes,
China.
exactly.
We're selling lots of stuff there, and don't worry about it.
Great stuff. You're awesome. You come back all the time. Shelby McFadden, investment analyst at Motley Fool Asset Management. I think we should do say-do ratios.
Yeah.
Like all the time.
Like Tucker, does he rate well in the say-do ratio?
I think he totally does.
Okay, all right.
Like he delivers. Like what you see is what you get. You know?
That's true. Kind of what you see is what you get. So
I don't know. That somehow sounded like an insult, but it didn't. I didn't mean it to be one. I'm gonna take this and run with it for a very long time. Okay, Shelby, thanks a lot. Really appreciate it. Loved having you join us there. You're looking at the S&P off by about a full 1 percentage point. Volume also kind of picking up here as well. We're going to cover all things markets related over the next 2 hours. In the meantime, let's go to Michael Barr for world and national news. Michael?
Thank you very much, Alex. Paul, John, Israel's military is promising an investigation and expressing sincere sorrow after 7 international aid workers, including 1 American citizen, were killed by an Israeli airstrike in Gaza last night. Israel Defense Forces spokesman Rear Admiral Daniel Hagari acknowledged the deaths of the World Central Kitchen members this morning.
I just spoke to WCK founder, Chef Jose Anders, and expressed the deepest condolences of Israel Defense Forces to the families and the entire World Central Kitchen family.
Prime Minister Benjamin Netanyahu acknowledged today that Israeli forces had carried out the unintended strike. The Florida Supreme Court ruled that the state's 15-week abortion ban was constitutional. The ruling paves the way for a 6-week ban to take effect. Loyola law professor Lori Levinson says this is a major departure by the court.
In that state, it had been accepted that the right of privacy included the right to an abortion. But today, the Florida Supreme Court threw that out, which means that presumably restrictions on abortion are constitutional, including the ones at 15 weeks and soon to be at 6 weeks.
Professor Levinson says the 6-week ban would take effect in the next 30 days. In a second ruling, the state Supreme Court decided voters in Florida will have the opportunity to choose the future of abortion in the state on the November ballot. The women's NCAA Final Four is set. Caitlin Clark scored 41 points to lead Iowa past LSU. UConn beat USC, so now UConn faces Iowa. South Carolina plays North Carolina State. And sad news, Larry Lucchino, president of the Boston Red Sox, former president, died today at age 78. Global news 24 hours a day, whenever you want it, with Bloomberg News Now. I'm Michael Barr. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. With this Bloomberg Business Flash, we had better than estimated readings on job openings and factory goods orders. And that's keeping markets under pressure. Good news, bad news scenario. 10-year yields hit the highest levels in 2024, but put further pressure on risk assets. Health insurers, the laggards in the S&P 500. This is on the news. They're not going to get the reimbursements they had wanted from Medicare. Tesla, of course, also weighing on the major averages. Deliveries were way off consensus. And shares of Tesla right now, they are down 5.8%. Well, the economic data suggesting higher for longer from the Fed is what's in the driver's seat for investors. That's according to Dan Morris over at BNP Paribas.
So the ISM, the confirmation for the personal consumption expenditures, inflation data, all of this is pointing to a bit more persistence in inflation and also in growth than the Fed seemed to let on. So I think that's certainly what the market's reacting to. Now, how bad that is necessarily for risk assets as opposed to treasuries is a very different question.
Well, the oil majors leaders right now, Phillips 66, for instance, that's up over 2%, as NYMEX crude flirts with $85 a barrel. S&P 500, 51 points lower, that's down 1%, 51.92 on the index. The Dow Jones Industrial Average down 385 points. That's down 1%. The NASDAQ 100, 260 points lower, a decline of 1.4%. Two-year yield, right now it's unchanged, 470. The 10-year, 6 basis points higher, and that is at 437. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Head over to youtube.com, search Bloomberg Podcast, and that's where you will find us. I'm looking at the shares of the Walt Disney Company, up 35% or 34% year to date. Mickey Mouse doing pretty well there, outpacing the market, outpacing all of its media, most of its media peers for that matter. A lot of balls in the air for the Walt Disney Company, for shareholders, for management, one of which is activist investors are active with Walt Disney Company. It looks like Disney today is going to get the better of one of them, Nelson Peltz. But let's bring in Geetha Ranganathan. She joins us. She's a senior media analyst for Bloomberg Intelligence. She joins us from the headquarters of Bloomberg Intelligence in Princeton, New Jersey. Geetha, what's happening with Disney and some of the activist investors? I know Nelson Peltz, there's a kind of a vote going on, a proxy vote today. What's happening there?
Yeah, so investors here, Paul, are really, they're voting on 3 competing lineups, okay? So one is, of course, the Disney suggested board lineup, which is its 12 members, of course, which includes, Bob Iger and a host of other people. Then you have Nelson Peltz, his fund is Trian, and that fund is suggesting 2 new board members, one of which is Peltz, and of course the other one being the former CFO of Disney, Jay Rizzullo. And then you have another activist investor, Blackwells, which is suggesting its own candidates, 3 new candidates for the board.
Why not? Why not get new candidates on the board? Why is Bob Iger so bummed about it?
So what Bob Iger has said, and this is especially in relation to kind of this whole challenge by Nelson Peltz and Trian, is Nelson Peltz doesn't necessarily have the experience. Yes, he has had a pretty good track record in the past when he's kind of launched these activist campaigns, but he doesn't necessarily have media experience. He doesn't know the various, and I mean, Disney is just a huge conglomerate operating in so many different areas, whether it's parks, you have streaming, you have linear TV, and it's kind of managing, you have, of course, the film studio, and they're kind of trying to manage a transition here, especially in their linear TV and streaming business. Nelson Peltz might not necessarily have the experience required for it, and if you just kind of look at what Bob Iger has been able to accomplish ever since he came back to the company, I would say he's done a really, really good job in terms of navigating the company through a pretty difficult time period.
So, Geetha, is this to the extent that the Disney gets its way with the votes today? Does that buy Bob Iger and his management team a certain amount of time to continue to remake this company into a streaming / content / parks company?
I definitely think so, Paul. I mean, and Bob Iger has kind of said this many times. He said, this activist investors coming in, Yes, it's good for the overall story, but it's also been an unnecessary distraction, especially at a time. This has been a really, really critical time for Disney and for Bob Iger. He said that he's worked in this 1 year harder than he has, in his 15 years as Disney CEO, and that's just because of all these different, unique challenges that has been in front of Disney. Obviously, having these activists continuously kind of breathing down their neck hasn't really helped. He has done a lot of the things that he promised to do. I mean, remember, he spoke about cost cuts. He initially came in at $5.5 billion. Now he's saying he's going to exceed $7.5 billion in annual cost cuts. He's talked about free cash flow. Free cash flow of this company is really going to surge over $8 billion this year. That's almost 70% higher than $4.9 billion last year. And really, they're kind of really firing on all cylinders. I mean, parks, which is 70% of their profits, is not only going to be a huge driver in fiscal 2024, but it's going to continue to be a huge, huge catalyst for many years to come. And I say that because they are investing $60 billion in their parks business over the next 10 years. They're adding a whole bunch of new cruise ships. They're expanding capacity. So that means more and more earnings. I mean, it's going to generate $10 billion in operating income just this year alone. And then, of course, you have the streaming business. And that's where a lot of the earnings upside is going to come from, because up until now, streaming was losing money, losing almost $4 billion 2 years ago, $2.5 billion last year. This year, it's going to break even. Next year, who knows how much it can generate, maybe $1-2 billion in profits. And so that's where you're going to see a lot of the EPS momentum in Disney.
So what does Nelson Peltz, for example, actually want? Like, I mean, I've read things that why was the Marvels all women? Like, why was Black Panther all African Americans? Like, okay, like that doesn't really do anything for me. So what are some of the changes that he would want to make?
Yeah, so he's talked about streaming profits, but I don't think he has much of a case there. I mean, Disney's obviously well on their way to breaking even and getting to good profitability. The one thing, of course, that he's kind of raised, and I think maybe Disney's underperformance gives him some fodder here, has kind of been the studio, right? So remember, this studio, the Disney studio, generated over $13 billion at the global box office in 2019. Last year, under $5 billion. Even Universal kind of overtook them. So obviously they've had a whole string of misfires. Nothing really has been working at the studio. That kind of has given him some ammunition. And he's spoken about, as you just pointed out, Alex, about all this woke content and people not necessarily going to the theater to get a message. They want to be entertained and all of that stuff. And maybe he does have a point there. But to that point, again, on the flip side, I mean, yes, they've had a whole string of, I think, some missteps and some misfires, but they are working to kind of reinvigorate all their major content franchises. And we're going to see some evidence of that in 2024. I mean, you have this big Inside Out movie. I know there's a movie that you're really excited about, which is Deadpool.
Oh, boy.
Yeah, baby.
Yeah.
Deadpool 3.
Yep. And then 2025, again, you have a whole bunch of new movies, Captain America, Snow White, Elio. And then 2026 is really going to be the big year, right? You have like 3 Marvel movies, you have, Pixar, you have 2 Star Wars movies, the Avatar kind of coming out end of 2025, so spilling into 2026. So 2026 is going to be huge.
Wow.
By all accounts.
All right,
so,
Geetha.
so they're definitely building up to that.
The last question, Bob Iger, are we ever going to get a successor here? What's the status of that? I'm gonna write you in for the successor.
Should be so good.
Yeah, I mean, so he's mentioned a whole bunch of internal candidates, Paul. I mean, you have all the 4 division chiefs right now who are in the running. The TV chief, Dana Walden. You have, Jimmy Pitaro, Josh D'Amaro. You have Alan Bergman. Again, Disney has always kind of looked within, but that's not to say that they can't go external. That would, of course, be the first time that they are going external since, 1984. I think that was when Michael Eisner came onto Disney. So, again, we're thinking it's going to be internal, but who knows?
Also, didn't James Gorman join the board?
Yes.
Didn't it happen like in terms of succession? Like that kind of gives it a little bit there?
A little bit of there. All right, Geetha, thanks so much for joining us. Geetha Ranganathan, she is the U.S. media analyst, actually the global media analyst. Let's be honest here. Bloomberg Intelligence, she kind of runs all of that media research. A lot of stuff going on in her world. Again, Disney stock up 35% year to date. So maybe the worst is behind it. There's been a lot of concern, just rightfully so, among investors for how these traditional media companies are going to kind of evolve into more digital plays, more streaming plays, and it looks like Disney's kind of on the road to getting there. That's what the stock price is telling us. S&P 500 off 1%. This is Bloomberg.
your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom. Look at some of the company news we're following. Well, the high cost of financing driving Americans to opt for more affordable automobiles. Budget sedans and compact SUVs from Toyota, Honda made eye-popping share gains in the first quarter. This according to Edmunds.com. The large pickup trucks, and that's one of the industry's priciest segments, losing ground in January and February, according to researcher Global Data. Several brands, including Jeep, Tesla, and Ford, reducing prices to win back inflation-weary consumers and trying to increase demand in the sluggish electrical vehicle market. Of course, we saw the delivery numbers from Tesla. That was a disaster. Taco Bell, Pizza Hut, KFC betting on artificial intelligence. According to the Journal, Yum Brands' new Chief Digital and Technology Officer has been increasing investment in technology and automation. For example, team members can ask app questions, an app that Yum has, questions like, how should I set this oven temperature? Can you hear my eyes roll? Since the pandemic, fast food chains have increased investing in technologies like digital ordering and more drive-thrus. And after welcoming guests for 67 years, the doors to the Las Vegas Strip's third oldest casino, the Tropicana, will be chained shut at noon. A demolition is now slated for October. They're making room for a baseball stadium. The lavish casino was a frequent haunt of the legendary Rat Pack. 10 seconds left. Can you name the Rat Pack? Alex?
Frank Sinatra.
Yeah. Dean Martin.
Sammy
Davis Jr., Joey Bishop, Peter Lawford, and I think Angie Dickinson was on that list.
She can be in any...
To be fair, he was reading that.
That's your company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, happy Tuesday, everybody. I'm Alex Steele alongside Paul Sweeney. You're listening to the Bloomberg Intelligence radio show / podcast. We are live from the Interactive Broker Studio right here in Midtown Manhattan. You can also check us on YouTube. We bring you all the news and all the analysis with our top team from Bloomberg Intelligence. They cover over 2,000 companies in 130 industries. And we also bring you world and national news. For that, here's Michael Barr. Michael.
Thank you very much, Alex. Paul, John, an aid group says an Israeli strike that hit its workers in Gaza killed at least 6 international aid workers and their Palestinian driver. The food charity World Central Kitchen said that the 7 killed included a U.S.-Canada dual citizen. Israel Defense Forces spokesman Rear Admiral Daniel Hagari.
We also express sincere sorrow to our allied nations who have been doing and continue to do so much to assist those in need.
Prime Minister Benjamin Netanyahu acknowledged the aid workers in Gaza were killed by an unintended strike by Israeli forces. Iran vowed revenge on Israel after blaming it for a deadly airstrike on its embassy in Syria. The strike in Damascus late yesterday killed at least 13 people, including 7 Iranian military personnel and 6 Syrian nationals, according to Iranian state media. Stephen Cook, Counsel on Foreign Relations, Middle Eastern Senior Fellow.
This is a significant escalation, and the risk of the Iranians responding in any number of ways is very, very high. The Iranians have attacked American forces, and American forces are in Iraq and Iran, which are obvious places. We've seen that happen over the course of the conflict that began on October 7th.
Stephen Cook from the Council on Foreign Relations. Sad news in the sports world. Larry Lucchino, former president of the Boston Red Sox, died today at age 78. A Florida man says NASA space junk crashed into his home. NASA's plan to dispose of a 5,000-pound pallet of space junk from the International Space Station was descended into a low Earth orbit and then let it burn up in the atmosphere over the Gulf of Mexico on March 8th. Well, on that same day, Alejandro Otero says something crashed through the roof of his Naples home, pierced 2 floors, nearly hit his son. A NASA official says they are analyzing the debris to confirm if it is from the space station. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Alex, Paul, John.
I mean, that's a big ruh-roh, right?
I hate when that happens.
When the space stuff falls in your house. It's
But
tough stuff.
is that a Florida man story?
That's a Florida man story from Naples.
How also then do you clear that up? Like, you can't just junk it. That feels hard.
Well, it was supposed to burn up, but obviously it looks like it didn't all burn up.
Cool. So it's also probably highly flammable. Anyway, thank you so much, Michael Barr. One story we're watching here. So if you live in New York, you know that it's raining out and whatever, kind of stinks. If you live elsewhere, particularly in the Midwest, you might be in for a little bit of pain here, Paul. Apparently, storms and tornadoes are now in the forecast for states across the Midwest in the United States, with further weather warnings and advisories stretching further east. Moderate risk of severe thunderstorms, which could bring hail, tornadoes, and straight-line winds on Tuesday across the Ohio Valley, including Columbus, Cincinnati, and Louisville. This is according to the U.S. Storm Prediction Center.
Is there a tornado season? Or
I don't know. That's a great question. John
There is a
Tucker?
tornado season,
knew
and
he'd
it's
know this.
expanding, and it's also farther north than it has ever been. So
Is
it's
it
just
kind of like in the warmer weather when there's thunderstorms?
Well,
Is
it's
that-
when the atmosphere from the north, which is cooler, mixes with the Gulf air, which is warmer and moist, and that's the ingredient.
Some of the, I mean, all natural disasters are by definition disasters. When you think about the floods, the hurricanes, but tornadoes are the one that get me. I mean, that is scary stuff because they come out of nowhere, and they just rip a path of destruction. You just, so you see some of our good friends in the Midwest and in Oklahoma and things like that. All the time they have to deal with that
Well,
stuff.
and also just that as the climate changes, you get stuff where you shouldn't get stuff.
Right.
And then you get, or not that you shouldn't, but you're not used
Don't
to it. So
typically
you don't
get it,
have the
right.
kind of protection against it. And that's where it gets really scary. Anyway, much more coming up in the next hour of Bloomberg Intelligence. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Dwayne Wright, Bloomberg Intelligence health policy analyst, get a sense of what's happening with those U.S. insurers here, some big movers there. We're also going to check in with Steve Mann. He covers the Teslas of the world, the auto industry, for Bloomberg Intelligence. Figure out what's going on with Tesla. They had a big miss there on the deliveries. Right now, let's take a quick look at what's happening in the markets, and we'll do that with Mr. John Tucker.
And this Bloomberg Business Flash being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. It's a bit of a good news is bad news scenario for markets. Job openings edging higher in February, even with major job cuts in technology and finance that we've been hearing about. The data setting the stage for the monthly employment report. Of course, we're going to get that on Friday. And investors, meantime, repricing Fed rate cuts following the stronger data seen in recent days. That is weighing on the risk assets. And Abigail Watt, economist with UBS, says, it's pretty clear the Fed certainly can take its time before ever cutting.
Given the kind of strength they've seen in the labour market, given the fact that they have seen we saw upward revisions to growth through Q4 last week, given the fact that they've seen that activity data as a whole remaining resilient, I think that does give them the space to kind of wait and see and digest that data before removing policy restrictiveness.
And 10 of the 11 major industry groups in the S&P 500 are lower right now. Consumer discretionary, the biggest drag, and that is where you're going to find shares of Tesla. Right now, the S&P 500, 55 points lower. 1% drop off there at 5188 on the index. And the Dow Jones Industrial Average down 445 points. The NASDAQ 100 down 276 points. A decline there of 1.5%. Two-year yields actually lower right now by 1 basis point, 469. The 10-year, that's up by 4 basis points. That is at 435. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash, Paul and Alex.
All right, thank you so much, John Tucker. So lots of things moving today. So we want to get you updated on all of it. In particular, we got the home builders down by about 2.4% if you're looking at the KHB, which is the home builder index for the S&P. Let's get to the why. Norma Linda's here. She joins us now from Bloomberg News. Nor, what's going on with the home builders?
Yes, the home builders are really taking a slide this morning after Wedbush cut several of the names to underperform from neutral. The analyst said that he expects a normal seasonal stock price decline into the summer as the seasonal trade window closes in April and May. As we know, the spring selling season is really, really big for home builders, and essentially what he's saying is that as we slide out of that time period, some of these home builders may see a bit of a pullback in that run that we've been seeing.
I've noticed a lot of new existing homes coming on the market. This is through my unofficial Zillow Street Easy research, which I thought was actually quite interesting, despite the fact that interest rates are still pretty high.
Okay, because we haven't had much of that.
I know.
Warner Brothers Discovery.
Yes, back in the antitrust space, Warner Brothers Discovery shares are slipping as much as 3.9%. Now, 2 members have left their board of directors after learning that the U.S. Justice Department is investigating whether Warner Brothers Discovery's service is violating antitrust laws. And those 2 members are really important because one of them is Stephen Newhouse. His family's business is the second largest holder of Warner Brothers Discovery stock. And Stephen Myron, the other person who's leaving as well, is a member and affiliated with the Newhouse family business. So a bit of a statement there.
And that Newhouse family business is Advanced Publications, long-time media company, privately held, great company. But again, some overlap there that they're concerned about the regulators may be looking at. So getting a little bit safe than sorry. What's going on in the insurance business?
Well, we're gonna go to someone to tell us about it. So, Nor, thanks a lot. We really appreciate it. Really appreciate that, Norma Linda joining us. The health insurance business important because you got Humana as the worst performing stock in the S&P, down a whopping 14%, and it's bringing down its peers like CVS, for example. Apparently, they're falling because U.S. regulators didn't boost payments for private Medicare plans like the industry had been expecting. So, Dwayne Wright is Bloomberg Intelligence health policy analyst. He's going to break this all down for us. Break it into normal person speak. What does this actually mean?
Yeah, so this is all about expectations. There's an expectation that the government would increase payments to these Medicare Advantage health plans like CVS, United Health, and Humana next year. Instead, what was proposed earlier this year was a payment cut. Health plans had been hoping for a mid-single-digit payment increase. We ended up with the same final rate for next year. So a disappointment for plans in terms of what they're seeing with their beneficiaries in terms of medical costs. They're seeing medical costs for their seniors go up, and the hope was that as a result, the government would increase rates appropriately.
So, Dwayne, who at the government who sets these rates, and how often do they do this?
So this is set by the government based on actuarial data reflecting healthcare spending in the traditional Medicare program, utilization of hospital services, physician services, and others. And so every year in February, we see a proposal which health plans then respond to and other stakeholders respond to in terms of whether that's the appropriate rate or not. And then the first Monday in April, the federal government or Medicare releases the final payment rate update for calendar year 2025. And this sets in motion some other aspects of the payment process, which is that these health plans then figure out, based on those payment rates, what kind of benefits they'll offer at what payment rates or premiums and other services. And then we'll see what those benefit packages look like around October 1st.
Why didn't they raise it?
Basically, it comes down to the data that the government is seeing. They are basically saying, as much as we're seeing some increase in medical care use, we're not seeing anything that's different from what we saw last year, which is what CMS indicated in their final proposal. They're also saying that a lot of the care that's being provided is in the outpatient setting. Those are typically settings like the physician office or hospital outpatient department. That's a lot lower cost than an inpatient hospital setting. So there wasn't a need to increase rates to the rate or to the level that health insurers were hoping for, and that what had been proposed in February was or should be adequate enough to cover the expected use of medical care for 2025.
So, Dwayne, what does this mean for consumers, for patients?
Well, we'll see. So we have to remember that these health plans can do a lot of things to mitigate the impact of a low rate or negative rate update environment. These plans can cut back on benefits. They can adjust the premiums for Medicare beneficiaries. But a lot of these plans also want to be competitive as to their peers. So, these plans might not necessarily change their benefits significantly. They might make some tweaks here and there, but I'm not expecting that we're going to see significant changes in the benefit structure because, again, plans want to remain competitive for the 2025 year.
And before I let you go, everything's going to get paid for, right? So, who's going to wind up paying for it? Eventually, is it going to just be the government that has to foot the bill?
Well, the government's going to pay about $550 billion in payments to these Medicare Advantage insurers. So, some of this cost will be maybe eaten up by the health plans in terms of, their margin might not be as good as they want it to be. Some of the beneficiaries may end up seeing some higher premiums than they did in 2024. So it's probably going to be a mix of some health plans taking up some of the costs, some beneficiaries taking up some of the costs through premiums. We may see some of the benefits go away, some of the additional benefits that aren't covered by Medicare. So it's going to be a mix of players that end up paying for this. But by and large, the government's paying a significant amount of money for these Medicare Advantage services.
All right, Dwayne. Good stuff as always. Dwayne Wright, healthcare policy analyst for Bloomberg Intelligence. Smart guy, despite his challenged undergraduate background, which was the University of North Carolina at Chapel Hill. We won't hold that against him as a Dookie. But good stuff from Dwayne Wright. Really appreciate getting his thoughts there. Insurance companies, health insurance companies, taking it on the chin today. Got a ruling here from about rates that the market was not discounting. All right, Alex, let's switch gears literally to Tesla. The stock is down 6% here today. They missed pretty significantly on their deliverables for the first quarter. Again, stock down 6% today, off 33, about 34% year to date. So definitely a challenging time for the folks at Tesla. Steve Mann joins us, global autos and industrials analyst for Bloomberg Intelligence. Steve, put into context this miss year. How big of a miss was it, and what does it mean going forward, do you think, for Tesla?
Oh, it's definitely a